How do we sell it? What is your means to sell people that are truly just ambivalent about what they should do?
I think we will start to see people, celebrities, famous people, trusted community leaders being the voice of you should get this, which I think will be really valuable to access these harder to engage communities. I also think that as more and more people get vaccinated, seeing friends and loved ones who get vaccine and who are safe and who are still healthy and who have been protected from coronavirus is huge. And the impact of that can't be underestimated. So I think having, public campaigns of real people who've gone out every day, who have gone out and gotten their vaccine and are back to work, are back to being safe, are being able to take advantage of those revised CDC guidelines is going to be a really big step forward. But we have to make sure that we're not sort of letting small communities be insular and showing them that people are getting vaccinated and building up that trust again.
I love that New Jersey yesterday, as John was talking about, is offering people free beer. You got Maryland saying it'll hand out $100 to people to get vaccinated. Then you've got Detroit coming out saying they'll pay $50 to people who who drive other people to get vaccinated. So definitely this is ramping up. There is a use it or lose it kind of a mentality that is increasing among the Biden administration. How much does that play into the vaccine diplomacy that you see them engaging in, starting to send out some of the vaccines to hard-hit nations that don't have enough?
Yeah, I think that the diplomacy is critical, independent of our vaccination rates. I think supporting an increase in global vaccination coverage is good practice for the U.S. It's good practice for the world, and it keeps everyone more safe, right? The more people we get vaccinated globally, any vaccine that goes into an arm versus expires on our shelves is better for everyone. And so I think it is playing into it. I think there's a huge piece around making sure that we're not sort of protecting those stores and then letting them expire, and the logistics around that are incredible. So all the work that's going into that, I think, can't be discounted. It is a strategy game, but it's also a movement and operations game that takes a ton of resources. And so when we think about scale up of production, that should be one of the top priorities, making sure that some of that vaccine that we're producing here is going directly to sites like COVAX, who can distribute it globally and have a plan in place already to do so.
Lauren, just finally to wrap up this conversation, help me get out of the New York bubble. The president's saying, we know that many adults haven't been vaccinated because they have found it too confusing or too difficult or too inconvenient to get a shot. It is hard to say that's true in New York City. Is that true of the rest of the country? And if so, where?
Yeah, I think it is true in areas where there's less public transportation, there's less access to technology, more rural communities, for example. I think finding sites that are distributing vaccine, that are keeping their hours regular, that people can access outside of work hours and don't have to drive multiple miles to get to, is the place where he's sort of thinking about when he says those sorts of things. The key piece that I think he didn't really touch on as much is making sure that people come back for that second dose. So if they got Pfizer and Moderna, making sure they get that full coverage. And I think that has been a little bit of a gap that we're seeing starting to come into play. So maybe identifying people who can only get one dose and making sure they have access and linkage to Johnson & Johnson, and then identifying those communities that either don't have transportation or don't have technology and getting the resources they need. I saw the other day that you could donate a vaccine ride on Uber, which I think is amazing.
So the same thing, Lauren. I think we both agree, though, we've got to do way more about telling people what they can and can't do once they've been vaccinated. That's going to be the real cure for this, I guess, if I can pick that word. Lauren, it's great to catch up. Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine. A statement from the Italian government on tourism. Here's how it finishes at the very bottom of it. It's time to book your holidays to Italy. We look forward to welcoming you again. Europe wants to reopen for business and reopen for tourism, Tom, and do it quickly.
And do it, the obvious is there, Milan, with the huge challenges they've had. John, you know the cities better than I do, but you wonder about down south, the more rural part, like Puglia, which I think you're a little bit familiar with. How do you get it done? How do you get it? And to me, it's the airlines. They got to get this airline process straightened out fast.
So Puglia is where the family is from, of course, Tom. There is a green pass domestically to allow people who live in Italy to travel between regions freely. Lisa, the big challenge, to Tom's point, point is opening up the airports again,
Yeah.
building out capacity in a much, much bigger way. Of course, they're already open, doing it in a much bigger way and allowing foreigners to come through, allowing people from outside of Europe and trying to get that reciprocation with the United States of America too.
And trying to get consistent standards in terms of what's accepted with vaccines, what type of vaccine is accepted, what you have to present, because we can see that these vaccination cards can be fabricated. Where are the concerns about that? These are some of the issues they need to work out, John.
Coming up, there's a new guy at UBS. So we promised UBS we'd give him some time. It's Luke Cowart, UBS Asset Management, Asset Allocation Strategist. Looking forward to catching up with a good old friend, Luke, in just a couple of minutes' time. We are, Tom. A little bit of sport, a little bit of baseball. I think he's a Yankees fan. We'll do that next. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
Right now, the markets are being fed an incredible mix of positive news.
We're potentially going to see faster prices, both in consumer prices and wages.
The danger is that we move into this period of elevated inflation because of the margin spike when everything reopens.
We do think it's transitory, but we also have to admit that there is a very fair chance that inflation will turn out to be sticky.
There's no question in my mind we're going to have a pullback at some point, but I don't think it's in the near future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is the Yellen Tantrum. I did that just to wind up Tom. From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. We snapped back from the losses of yesterday on the S&P, up about 1/3 on the NASDAQ, up 0.6%. This from the Nobel laureate Paul Krugman out on Twitter in the last couple of moments, Tom. If it should happen to rain, we have umbrellas, says the Treasury Secretary. Panicked pundit says she's predicting a hurricane. That pretty much sums up the last day's price action.
Does. Yeah, that does capture it nicely as well. I mean, we don't have an opinion on the direction of inflation other than for the politicians, John. It's not about Paul Krugman. It's not about Janet Yellen. It's about the voters, and there's no question the voters see inflation in gasoline and many of the products, including at the grocery store.
And it's about the price of labor, Tom. They will want wages to go higher, and if you've got a labor shortage, there is a pretty simple solution to addressing that.
You nailed it with your observation on Montana. I missed that news item, and I mean, what the governor of Montana is doing, is that our future?
Yeah, I agree with that. The governor of Montana, Lisa, of course, unveiling what he thinks is an incentive to get back at work and what he thinks is a disincentive to stay out of the labor force, and that's addressing federal unemployment benefits.
And frankly, it shows the fault lines that have emerged between Republicans and Democrats, conservatives and liberals when it comes to this further stimulus that we could potentially get or not get. How much are you doing handouts versus supporting people who have been left behind by an economy, particularly after the pandemic, John?
ADP report 1 hour and 14 minutes away. Here's the price action this Wednesday. In the equity market on the S&P 500, we advanced 41.72 on the S&P, up 1/3% on the day. NASDAQ got hammered yesterday. Let's be clear about that, Tom. We do bounce back on the NASDAQ 100.
It was an 8% move. I measured it top to bottom. NASDAQ 100, John, 8% move down.
Yield higher by a basis point, 160.67, up 0.0125 on the day. And crude, WTI 66 handle, 66.40, Lisa, approaching 70 on Brent. We're up 1 full percentage point on WTI crude.
So since both of you were talking over each other, I do want to just weigh in on that. This idea,
Lisa, what's new? That's the show, isn't it?
This idea, though, that the equity market responded more to the potential for the Fed tapering sooner rather than later. The idea here that perhaps the riskier assets are the ones that have been more inflated by Fed policies than even the markets that they have more control over, which is the rates markets. Anyway, we will dive into that over the next couple of hours. 8:15 a.m., we get the ADP employment change. The expectation is for 850,000 new jobs to be added versus 517,000 in the prior month. Moving toward Friday, the key question with this jobs report is how high does the bar have to be for people to believe that the Fed could change their policy? We've been hearing it could be, as Steve Englander said, something around the mark of 2 million or more jobs. Then 8:30 a.m., we get Treasury refunding announcement for the quarter. The expectation is for it to stay the same at about $126 billion. The idea here is, are we reaching peak net issuance of Treasuries? The supply-demand dynamic, demand may be staying the same, maybe going down a little bit, but the supply perhaps staying the same or going down next year. Then 10 a.m., we get the ISM services data. This is going to be a service sector rebound. How much are we getting momentum on that front at this point, John? Or is it too early to tell still with so many people not yet vaccinated?
Is that a big deal, John?
Just around the corner. I always think the ISMs and PMIs are interesting, Tom, and it does reveal what's happening in this economy right now. Higher prices, a labor shortage, big demand, trying to meet that demand.
Wait, did Tom really just do that? I said something, and he's like, really? Does anyone care, John? Do you care?
Yeah, he's just asking me what I think about the situation.
No, in the old days, they were like ignored.
Lisa, to be fair to Tom, you have put things in the day ahead sometimes that have been, shall we say, questionable.
John, coins up 30%.
Like when Lisa puts the beige book in there sometimes.
Yeah, I'll give you the beige book. Here's the beige book for
every month.
Good Morning Iowa on Bloomberg Radio and Bloomberg Television. Corn up 30% since April 1. And John, that's got an international character to it.
Copper and crude as well have just absolutely ripped this year. Let's bring in Luke Cower, UBS Asset Management Asset Allocation Strategist and former Bloomberg News cross-asset reporter. Luke, great to catch up. We're doing baseball, we're doing ice hockey. How do you want to start this? You get to choose, sir. You get to choose.
Well, we can start with markets if that's not too much of a problem.
Okay, we can start there if you want as well. Luke, welcome back. It's good to see you.
Show just came to a complete halt.
You don't want to talk about the Yankees cap I can see just around the corner in the shop. We'll do that in a little bit. Let's get to the 4 investing lessons from China's recovery. That's where your research, your attention has been taken over the last couple of months, Luke. Why?
I think it's pretty useful kind of 1 year out from China starting to reopen before a lot of major economies to go, okay, what is this more complete economic recovery in terms of output, just in output terms? What lessons can we draw on that in terms of how asset markets are going to behave as more and more economies kind of reach that state of more complete recovery? And so the first lesson is, I think, to stay away from the Chinas, to stay away from regions that are, from a risk perspective, that are just a lot more advanced in the cyclical recovery, to migrate more towards the places where there's scope for positive surprises, to your Europe, to your Japan, to your EMFX. That's definitely one. The second is to not fade the strength in the goods sector. We continue to see just robust readings, well above 50. If the U.S. is slowing down from 66 to 60, that's still a pretty incredible print in that context. So to fade that, to know that when we get services reopening, that's not the baton being passed from one runner to the next. That's a jet engine getting another one right there.
Yeah, look, what's so important here, I love your China note, is the basic idea of Asia Pacific out front. DuPont mentioned that yesterday, I believe it was, in their earnings report. How do you play a Pacific Rim lead and resurgence? Do you do it through multinationals in Europe and North America, or do you go direct to Asia?
So I think our view is not necessarily that these places will lead in terms of the vigor of the recovery, but more that they're just on the leading edge of it. And so you do want to go kind of more westward to your developed markets that haven't had the same degree of recovery yet. So that's kind of that's more the view there, Tom.
How much is China really a story that can be used as a precedent, and how much is it, dare I say, idiosyncratic? The idea that they're starting to pare back on some of their easy money policies to try to reduce some of the leverage, the fact that they're in a very different economic cycle when it comes to their evolution toward a more mature economy.
Yeah, Lisa, definitely some nuances need to be taken there in discussing China, but the broad contours of what you just discussed, the idea that policy support as you get to that point of complete output recovery is going to become more two-sided. That's not just, in our view, a China story. That's going to be something that's natural across developed markets as you kind of get more of a move from the handoff from public to private, and just the general ebbing of the fiscal impulse as you do less just by not doing more. And that, again, is a place where you see it in China in terms of the dialing down of the credit impulse. And you're seeing that in the U.S. in terms of future policy discussions, the infrastructure package. It's going to come, we're being told, with higher taxes. So the U.S. policy risk right now, as it is in a more advanced state of recovery than other DMs, also getting much more two-sided. So that broad lesson, we think, very applicable for how you approach other markets.
Where's the dollar call for you and the team now, Luke?
I think renewed conviction in the dollar call, especially based on the events of, say, the past month. You've had European vaccinations really accelerate. You've had, the U.S. PMI in manufacturing peak, and definitely peak relative to the rest of the world. I think that's the important part there. When you're thinking about how to trade, potential peak U.S. activity in the goods sectors, there's a lot of different directions you can go. It's something that could make you kind of outright bearish, or it's something that could make you outright bullish treasury. We think kind of the better ways to play that are focus on ex-U.S. equities, where PMIs are still going up, and focus on dollar weakness. So renewed call for dollar weakness, especially against European FX and a lot of the higher beta EMFX.
Okay, that's great, but come on, Euro, Luke, 122, 123. When does Europe start screaming over strong Euro? Last time it happened sooner than pundits like you thought.
So I think, FX always matters. It definitely matters to the policy-making discussion. FX matters a lot less when global demand is growing as strongly as it is. When we're fighting in FX terms over a pie that's pretty darn small and expanding at a slow pace, FX matters a lot to policymakers. When you're growing at such a strong clip, you can tolerate a lot more foreign exchange strength.
He nailed that.
I know, that went too well. Just a quick word, Luke, on the Yankees, just to wrap things up.
Hey, I mean, there's a lot of developments in April, like a treasury rally, a growth making a bit of a comeback against value that you want to fade. It's like the Red Sox leading in the AL East. But there's some like Garrett Cole AL pitcher of the month, a trend in April that you can kind of have some confidence in going forward. So you got to know which trend is which.
This is amazing. Cass and Kawa resurface on the same day. John, I think they've won 6 out of 7.
What time's Doug on? When's he
I don't know when he's on. He's on at some point.
Just finishing with a nice right hook there from Luke Cower. Luke is going to catch up.
Yeah.
Luke Cower there of UBS.
Luke, did you actually plan that? How long did it take for you to come up with that?
3 or 4 minutes to seconds, depending on which is more impressive.
Good right hook.
Luke, got to see you. We've got to leave it there. Good to see you. Equity futures this morning, up about 1/3 of 1% on the S&P. We bounced back on the NASDAQ, up 70, Tom. We advance 1/2 of 1%.
Mr. Hollenhorst over at Citigroup with a really good observation, John. I love some of these research notes midweek. ISM, John, which you look at more than me, he notices construction in services, which means the lumber dynamics are in services as well. That's something I think a lot of people aren't familiar with.
Yeah, and Tom, I think this is where the pushback has been for the Federal Reserve as well. When you hear from Chairman Powell, he talks about the data we've seen. He keeps referring to one payrolls report. We've only seen one payrolls report. We've seen a ton of data elsewhere that's given you a pretty decent picture of this recovery for the months ahead.
I agree. In his defense, you got to have 3 months here to get the moving average.
No, totally
going.
with you. I agree with you, Tom. I agree with you, but it's not quite given a full picture of what's happening in this economy right now by just saying we've only seen one labor market report as if it might be an aberration or some sort. Lisa.
Yeah, I think that they're trying to show their dovishness, and the question is just whether the data will be so good that they'll be unable to, and the markets will move ahead of them.
41.71 on the S&P, coming up at 8 a.m. Eastern Time.
Captain Obvious.
In about 50 minutes from now. I wasn't suggesting that. Leon Cooperman, Amiga Family Office Chairman and CEO, joining us a little bit later on. Yield to higher by about a basis point, 160.67. Euro dollar unchanged at 120.15. Your S&P 500 up 1/3 of 1%. On radio, on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Treasury Secretary Janet Yellen wants to make it clear she was not forecasting interest rate hikes to rein in any inflation spurred by President Biden's proposed spending. That came after remarks earlier in the day that ruffled. Yellen says she doesn't anticipate a bout of persistently higher inflation, but if there is one, she said the Fed has the tools to deal with it. And we asked the chairman of UBS, Axel Weber, about Yellen's initial remarks and the impact of a growing economy.
I think he just spoke in general about what the Treasury Secretary needs to have some expectations around the yield curve and how to plan fiscal expenditure. So I think he was just reflecting what her forecast, as well as everybody else's forecasts that are on that table, reflect that basically we cannot assume for sure that over the next 3 years interest rates will stay anchored.
Weber said that interest rates and central bank balance sheets are part of the discussion going forward. And the coronavirus wave that plunged India into the world's biggest health crisis has the potential to get worse in the coming weeks. Some researchers project the death toll could be more than double from where it is now. One problem, a shortage of tests could prolong the outbreak for over a month. SpaceX has received more than 500,000 pre-orders for its Starlink satellite internet service. Founder Elon Musk says he anticipates no technical problems meeting the demand. SpaceX has not set a date for Starlink's service launch. The company plans to eventually deploy 12,000 satellites. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America.
There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Too much of the burden in our city and our country is placed on the backs of workers, while big corporations and wealthy people continue to get richer and richer. And so I think it is important that we take a look, certainly at tax policy and what our priorities are moving forward, so that we ensure that everyone have a fair shot and an opportunity to live out the American dream.
That was Kim Janey there, the City of Boston interim mayor. From New York City this morning, good morning, alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Wednesday morning, here's the price action. 2 hours and 12 minutes away from the opening bell. Equities up 12 on the S&P. We advanced to 41.70, up a third of 1%. Yield to higher by a basis point, back through 160 on 10s at 160.49. And Tom, euro dollar, really muted price action. 120.13, a little bit later this morning. An ADP report in America. The estimate right now, 850,000.
Yeah, 3 days of job data. We go beneath the headline numbers at 8:30 Friday morning. John, to your point on muted, I like what you said there on FX. And EM, I see a little bit of a backup in Mexican peso, maybe news driven. And also Turkish lira is testing 8.36. That'll be one to watch as well. Speaking of EM, there is this pandemic. Josh Wingrove on the watch at the White House, and clearly President Biden speaking this up as he speaks of the United States as the arsenal of medicine in virology against COVID-19. Josh, can we do it? Can we actually do a medical Marshall Plan to these beleaguered nations?
Well, it's an open question. The reason he's pivoted to it is because he doesn't really need the shots at home anymore. The demand is really drying up in the U.S. in nearly every state. You know, that is even with a collapse in supply. Remember, we were thinking we'd have 10, if not 100 million Johnson & Johnson shots by now. We don't have that. Still, we have more than enough for what we need. So that's why the U.S. is saying we're going to start giving stuff away, including that AstraZeneca doses. So you heard President Biden say by July 4th, we're going to have 10% of total production. He's referring to those Astra doses that he can't even use domestically, and there isn't a lot of demand for, even if he could. And they're going to give them away to countries. They haven't said which. India looks like a key candidate. The takeaway from his speech yesterday is things are slowing down. His new goal is essentially that the rate of shots over the next 60 days will only collapse by half of what it has been over the last month or so.
How do we do this? Is this a military exercise to distribute all this? How does the White House perceive that we will actually affect a global distribution?
I think that it's twofold. Number one, he's going to get out of line. And right now, he's been blocking other countries from buying directly. We learned this week that Pfizer, for the first time, is sending U.S.-made doses to anyone other than the U.S. government, in particular Mexico and Canada, are getting supply from its production. So that Biden doesn't control that directly, but by just simply getting out of the way, he'll unleash that U.S. production on other countries that have ordered it directly from Pfizer. And then the second side of the ledger is stuff that he will give away on his own. That it probably will include more AstraZeneca. It could include those Johnson & Johnson shots. Remember, he had that tie-up with Merck. The whole point of that deal is to raise production in the end of 2021, when presumably the U.S. won't need many, if all, or all of those shots. That'll be about export. So Biden will sort of, send these doses out twofold, either directly or by simply stepping out of the way and letting Pfizer and Moderna do it on their own.
Josh, President Biden talked about confusion about logistics around getting the vaccines. Perhaps that's true. Perhaps that's a little bit less so in certain areas. There is confusion, however, on the path to normalcy, what normalcy looks like, how quickly people can actually start getting together with other people, not wearing masks, whether you have to get inoculated to go back to work if you're a federal employee. What's the guidance? What's the sort of sense you're getting in terms of how much the federal government will lead and how much they are preparing for all of these measures and laying out some sort of framework?
They're being really cautious so far. And, critics are saying too cautious in some cases by just slowly bringing it up. So they had their big announcement that, hey, if you're vaccinated, if you're not around a lot of people outdoors, you can not wear a mask. Well, most people who are vaccinated probably thought they could do that anyway. I mean, that wasn't really all that big a deal. So they really are going in baby steps. I think it's a case where they're just trying to rein in steps that people are already taking anyway. In other words, they don't see themselves as driving the behavior, but almost, pulling it back a little bit. That other thing is we just don't know how anyone, federal government, private companies, a school, will require vaccination proof. Remember, anyone who's gotten that shot knows you get just a paper card. It's the simplest thing in the world. And it looks like a third rail issue to Biden. They take every chance they get to say, we will not require vaccination registries. It just leaves you with the impression that the polling is awful on it. And so they are not touching that with a 10-foot pole. And so we will never have some sort of central database to prove it. It's going to leave it up to everyone, every individual institution to set their own rules.
That's the domestic story. What about the international one, Josh? What are we doing to open things up again and get people to travel back in to the United States if they have been vaccinated? I've been absolutely fascinated by what's happening in London and the UK. Here's a story on a similar trajectory to the United States of America, and no talks publicly about reopening that travel corridor in a much bigger way. Why not?
It's a good question, and there's been reciprocity questions, right? The EU is moving also to sort of allow traveling by people who can prove vaccinations. The U.S. simply just hasn't done it yet, and we just don't know why. I think they're sort of signaling that there'll be news to come soon on that, but it does raise that question. If the CDC says, okay, you can start traveling back and forth if you can prove vaccination, then it's going to go back to that third rail question of proving vaccination, and it'll stoke fears there. But they have not said, is the short answer, when they will resume travel.
Similar story in the UK as well, Josh. It's just the big topic right now that nobody wants to discuss publicly, vaccine passports. Josh Wingrove, Bloomberg White House correspondent. Josh, always good to see you, sir. Thank you. The president's new target, 70% vaccinated by July 4th. The current data, 56% of adults have had at least one dose, 41% fully vaccinated. Tom, we got to get what? An extra 100 million over the next 2 months, I believe. The average over the last 7 days, we've come down from about 3.5 million, 3.4 over the last month to about 2.2 million per day on average over the last 7 days.
Write it out per day. I'm curious what you two think. I mean, I believe I have a U.S. passport, and it's not a big deal.
Right.
You have a U.S. passport.
Why am I upset if I have a vaccine passport?
Some people are worried that that's the start of a loss of freedom, Tom, and then it goes somewhere deeper, somewhere further that they don't want things to go. You give up a degree of freedom around your health, your medical data, your health history. And that's just the beginning. That's always the concern. Is that not a legitimate concern? That if you hand over power to authorities, the federal government, that you never get it back and that it goes deeper, it goes further?
In a health crisis, there also are different parameters, though, in terms of what is being free. And not to get all philosophical, but the idea of if everybody is going to contribute to some sort of registry, that gives everybody more freedom to move around and have faith that there is some sort of way to determine people who are protected. That is the other argument.
It is always the ethical argument. You have to give up a degree of freedom to gain a greater degree of freedom from somewhere else. Does this country, does everyone in it want that data on one centralized system? Does it? That's the question we've got to ask.
And that's a really controversial question.
I guess there wasn't a polio passport, to be
clearly.
honest. A measles passport, whatever.
No, but schools require it. in order to enter. And
Thank
so will schools be able to
And
require
private
this?
corporations will make their own decisions on this
Yeah.
as well. I agree.
Yeah. Well said, Lisa.
Coming up, Thomas Coster.
Well said, John.
Big Tech Wealth Management Senior Economist. I'm okay, Tom.
Well said.
Don't need the validation.
It was well said,
Up a
John.
third of 1% on the S&P.
That
Yield
data
higher
check,
by a
John,
basis
was
point.
well
160.
said.
Oh my God.
32. You are trouble.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
2 hours away from the opening bell in New York City this morning. Good morning. Here's the price action. It's Wednesday. Equity futures 41.73 on the S&P, a lift up 15 points. We advance about a third of 1%. On the Nasdaq, we advance about 0.6%. You're very familiar with the conversation in earnings season so far about execution, about costs, about the ability to pass on those costs. We've seen it in the data too. The PMIs, the ISM. You might see it a little bit later as well. In the data when we get it. The ADP report comes in about 45 minutes' time. Switch up the board and get to the commodity market. The rally we have seen in commodities this year has been absolutely phenomenal. Here's two. Copper and crude. Copper on a year up 28%, just short of 10K. We breached that level in the past week. Brent approaching $70 a barrel, up by 34%.
Thank you.
On crude year to date. And these higher transportation costs are part of the conversation, higher freight costs. We saw that, Tom, with Under Armour yesterday. Really decent numbers. Boosted the outlook as well, better than expected. But when it came to margins, that's what spooked people. And that's where the attention is at the moment.
We're focused on corn, we're focused on wheat, we're focused on whatever. And you're right, John, Brent at $70 has really crept up on us.
Yep, and the demand is there to back it up in this country at least.
That's
and
well
abroad.
said.
It's coming back. Thank you, Tom. Where's that coming from?
I have
that
no
line,
idea.
Well said.
I read
Do
it
you want
in
me
a book.
to validate your words?
I'm reading Jane Austen. Leave
Well
me alone.
said. Okay, carry on reading. Switch on the board and finish on this. 2s, 10s, and 30s. Lisa, you should be Dr. Phil. I don't know how you do it. 2-year yields unchanged at 0.1625%. I think we've got to reflect on yesterday just a little bit more. A rate scare, but no movement in rates? Really? I saw a NASDAQ scare for a moment going into the comments from Secretary Yellen. I saw a NASDAQ scare coming out of them too. Didn't see anything happen at the front end of the curve, and that's going to be the test. If you really think rates are going to go up, if there's a real concern about rates and they're going to go up, if you want to see a sign of that, a credible sign of that in the market, don't go to the NASDAQ. Go to the front end of the yield curve in America, 0.1625%, because that is where the prospect of high yields will show up. That is where you'll see it in the bond market, and that is where we did not see it yesterday. Lisa, I can see the face you're pulling out the corner of my eye. Just say it. Say what you want, and then we can move on.
Is that really the case if it's about tapering, not necessarily even the rate hike?
Secretary Yellen's comments were not about tapering. They were about interest rates. Now, if we want to talk about tapering, I agree with you. Maybe an equity market correction. And that might actually start the green light for the sequencing towards higher interest rates. But Secretary Yellen was talking about rates yesterday. And everybody was talking about an equity market that had a big downdraft because there was worry about rates. Spooked by a rates comment. What happened in rates yesterday?
It's truly a mystery. I would agree.
Do I get a well said? You're
well
2
said.
years, 16
well done.
basis points. Thank you. I feel so much better.
Good, I'm
Here's
glad.
Romain Bostic with your movers this morning. Morning, Romain.
Hey, good morning, John. Let's go back here for a second to what's been going on in the commodity space here. You mentioned copper, of course, over there in London right now, holding at that 10,000 level. You're seeing that also reflected in some of the equities this morning. Freeport-McMoran up about 1.4%. You got Bank of America strategists saying basically the copper market will be in deficit by the time we get towards the end of the year. That will continue to act as a tailwind for some of these companies like Freeport-McMoran and Southern Copper as well. You're also seeing a lot of those inflationary pressures actually work to the advantage for miners like Barrick Gold. Of course, its U.S. Ticker here, GOLD, that's up higher here in the pre-market by about 0.7%. And of course, everything that's been going on in the oil space with Brent crude floating with 70, and of course, NYMEX crude floating with 67. ConocoPhillips shares, they're up higher here in the pre-market by 2.5%. They reported earnings yesterday. We had CEO Ryan Lance on the program yesterday afternoon, and he talked about basically they're looking for any rock they can find to drill. They're saying this is a persistent trend now that they're going to see with regards to oil prices continuing to drift higher, as well as some of those end product prices continuing to drift higher as well. He said that's going to be very bullish for his company as well as for a lot of his competitors.
Romain, we got GM coming out, Mari Barra with David Weston here in a bit. Romain, give us the filter that you see where I see a headline that says GM strength, especially in North America, China, and GM Financial. I mean, we get back to the recovery of China leading the way.
Yeah, this is a company that not only is able to expand on production, being able to take advantage of demand, it's also got tremendous pricing power, at least in this current environment. On top of all of that, you have sort of the innovation, or at least the perception of innovation that a lot of people see Mary Barra doing with her, the progress that she's been making on autonomous driving and, of course, on alternative fuel vehicles. This continues to be a stock that, I guess, for a certain period of time, at least, was very underappreciated, not necessarily underappreciated anymore. It'll be interesting to see what comes out of that interview. David always has is able to get some pretty good comments out of her.
Romain, thank you so much. Romain Bostic to close this afternoon and continue the earnings soiree, to say the least. This is a really important interview. We speak to economists, but rarely do they piece together 1 and 2 quarters with confidence. Thomas Kosters is with Pictet Wealth Management. He's looking at 10% growth, and then he boldly says 6% follow on. And Thomas, that's an 8% summary over 6 months as well. Are we grossly underestimating the sustainability of the kind of earnings, the kind of global and U.S. oomph that Romain was just talking about?
Right. So indeed, I think Q2 is likely to be the strongest quarter in U.S. growth this year. That's mostly due to the savings that are going to be spent this quarter. Again, they receive checks in the mail in March. And they're going to spend them in April and May. And so that means, very strong growth in the second quarter. And after that, yeah, I think we'll have less fiscal support. We'll have also an economy that returns to its pre-coronavirus trend. And we know it will be more difficult to get strong growth in the second half of the year, and especially in 2022. So yeah, I would expect growth to moderate in the coming quarters after a very strong second quarter.
On a trend basis, do we moderate down to something that's gloomy? Do we moderate down to some run rate that's in your head? Or do we moderate down to, frankly, something that's more buoyant?
Right, and my answer is we just go back to the pre-crisis trend, no more, no less. But I think I'm against the view that we're in the roaring 20s and that we're going to leave a new era for U.S. growth. I think we're just back to normal, and back to normal means still some struggles in terms of productivity and also demographics as well. And by the way, the news on the demographics front are not good. With we see less fertility, less birth, and so on and so forth. Yeah. So yeah, but I think the real issue I have is with regards to the savings rate. Are we entering a new era where the savings rate may stay higher than pre-crisis, or is it going to really go down or even lower than pre-crisis? I think consumers will stay a bit cautious going forward. So I would expect actually the savings rate to remain a bit higher than what it was pre-COVID.
Thomas, that's three massive themes that we need to get into. One's the demographics. The second point is the degree to which we will really pare down the savings rate and lead to a sustainable boom in this country through the rest of this year. The third one that I want to pick up on, though, is the near-term risk going into the payrolls report. We can gauge demand in several different ways in an economy. You can see it in the PMIs, you can see it in the ISM. There is a demand boom, arguably a demand shock in this country right now. That's leading economists like you to look for huge numbers this Friday in the payrolls report. You yourself looking for 1.5 million, others, the median, in and around 1 million. The risk is, though, Thomas, that we see the demand, but we don't see the end result. That actually it's quite difficult to get the hiring done. We're talking about real people here. 1 million, 1.5 million. What's the risk around that, Thomas? Not the demand is less than expected, just that it hasn't ended up with the result many people anticipated.
Yeah, you're right. And first, on the demand side, let me stress that point. I mean, demand for workers is really huge. And we see that in all economic data, like all the business surveys and so on and so forth. You see firms really want to rehire. The question is, will they come? And here it is true, there is a bit of uncertainty here. And the uncertainty is also due to very generous unemployment benefits in the U.S. And you may argue that some people prefer to stay on high benefits than to go back to their work, because I think to go back to Econ 101, there are two ways to adjust supply and demand. It's either via prices, or in this case wages, or via quantity. And what we seem to be seeing is that firms are not yet ready to increase massively wages to rehire. So there is still a lid on wages, if you will, and that means that potentially workers may be more hesitant to come back. So that's the main risk going into Friday's reports. But again, all the demand side indicators are really strong, and there's really massive demand for workers right now.
Thomas, really interesting thoughts. I want to just pivot quickly to another really interesting thought that you had in your recent note, saying that inflation won't necessarily come on a sustained basis from this supply-demand dynamic that we're talking about right now, but really the risk of a loss of confidence when we transition to central bank digital currencies and money supply going directly in consumers' pockets in the next recession. Can you elaborate?
Sure. There is an inflation debate right now. It's mostly linked to the productive capacity, to the manufacturing cycle. I'm less worried about that side of things. I'm more worried about the money supply and central banking angle to the question. And that is that if central banks go down the route of central bank digital currencies, and to caricature, basically they'll be able to put money directly into your pockets. that's a route which worries me a bit. And I think the inflation risks coming from CBDCs, central bank digital currencies, is actually much higher and much more pernicious than the inflation risk coming from the productive side of the economy.
Thomas, we've got to leave it there. Thomas Kostek, looking forward to the payrolls report this Friday and looking for a big number over at Pictet Wealth Management, looking for 1.5 million. I want to turn back to the GM numbers. GM is not Ford. That is the takeaway this morning. That is up by more than 3%. Unlike Ford, which had to really put some cold water over previous guidance, GM is affirming their guidance. They do talk about the chip shortage. They say, though, that it won't impact growth. They do have a small comment on production downtime expected at some point in the second quarter. But Ford got absolutely hammered when it had to cut production by 50%, at least planned production for the second quarter last week. And that stock was down hard last Thursday by more than 9%. And that's the difference, Tom. Execution within the sector, not just a broad sector story.
Major shout out, Ite Macaulay at Citigroup absolutely nailed this distinction, John. What you said, we make a joke about it, but it's well said. It's been a huge polarity between Ford Motor and General Motors.
I'm really looking forward to the comments coming from Mary Barrett a little bit later, just to try and get a little bit more detail on those production issues, because the language in the statement is just a bit vague. It's not as upfront and out there as maybe Ford was last week. Mary Barrett, General Motors, the chairman and CEO, with David Westin a little bit later this morning from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The world faced its worst hunger problem in at least 5 years in 2020 due to the pandemic, and the outlook remains grim for 2021. Some 155 million people across 55 countries suffered from issues ranging from a food crisis to famine. That's 20 million more than the previous year. London is emerging from lockdown, bruised by Brexit and the pandemic that hit the UK capital harder than other regions. London accounts for about a quarter of the UK's output. It suffered almost 30% of the drop in payrolls nationwide. Residents are moving to the suburbs, and Britain's exit from the European Union is draining away high-paying work in finance. And President Biden wants 70% of U.S. adults to receive at least one dose of the coronavirus vaccine by July the 4th. According to the CDC, 56% of adults have received at least one shot. The president says that to make it easier, the government has been encouraging vaccination sites to offer walk-in appointments. And shares of actress Jessica Alba's Honest Company begin trading today. The personal care brand raised $413 million in an IPO priced within a marketed range. Honest specializes in baby products such as diapers and wipes. Alba, the co-founder, has a stake valued at about $90 million. And the baby drought in the U.S. got worse last year. Births fell 4% from 2019 to the lowest level since 1979, 3.6 million. It was the 6th annual drop in a row. The decline will likely continue this year when the brunt of the pandemic will be recorded. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Friday is Jobs Day on Bloomberg Television. Will unemployment move lower, and how will markets react? Plus, special guest, Minneapolis Fed President Neil Kashkari. The April Jobs Report, Friday morning on Bloomberg Television and Radio.
One of the ways we're going to get to 70% vaccination is to get our business community to be proactive, just as we are at the state level. In fact, we had a good call with the Chamber of Commerce on this topic this morning. I think the transit commuting reality will be slow to recover, but I think when folks come back and actually participate, it'll be a positive experience.
Phil Murphy there, the New Jersey governor from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramovich, I'm Jonathan Ferro. In around about 25 minutes, we'll get you a number from the ADP. The ADP jobs report just around the corner. Going into that, up 15 on the S&P 500, 41.73. We advanced 0.4%. Yields up about a basis point on a 10-year to 160.32. Euro dollar unchanged at 120.15. GM rallying in the pre-market, up by around about 3%. Out with earnings just moments ago. Unlike Ford, they affirm their forward guidance. The company and Mary Barra saying the following on the chip shortage. Let me bring this quote to you, Tom. Quote, our supply chain and manufacturing teams are maximizing production of high demand and capacity constrained vehicles. Our engineering teams are creating effective alternative solutions, and our sales teams, together with our dealers, are finding creative ways to satisfy customers despite lean inventories.
John, you nailed it 30 seconds ago, maybe 3 minutes ago. I can't remember. To me, it's got a real boilerplate feel to it. Yeah. And the Weston Bar conversation is going to be way more important. It's not like J.P. Morgan where Diamond's actually saying what's on his mind. Tom, I'm sorry.
I agree with you.
It's homogenized.
I agree. Ford's come out and said we're going to have to cut 50% of planned production in the second quarter. Let's put some numbers on it. I do think that this headline, though, helps the stock, that we're prioritizing full-size pickups, full-size SUVs and EVs for chip supply, and this won't damage EV growth. Remember, it's the EV story that has really delivered some big gains, helped deliver some big gains outside of the reopening for the likes of GM and for Ford too.
Yeah, absolutely. We'll have to see where that goes. Futures up 15, Dow futures up 72. The VIX comes in almost a figure, 18.63. David Wilson joins us right now, looking at a chart, and particularly looking at a chart not on Apple, boring, Amazon, boring software. David, what do you have?
Well, I mean, this is an industry group that's really taken a bit of a hit lately, at least in relative terms.
Crushed.
And Jonathan Krinsky over at Baycrest Partners sort of highlighted it yesterday. He was focusing in on an exchange-traded fund with the ticker IGV that tracks something called the S&P North American Expanded Technology Software Index. Now, I know that's a mouthful, but we're talking about companies on both sides of the U.S. and the Canadian border that focus on system software, application software, and home home entertainment programs. So when you put it all together, this is a group that peaked relative to the S&P 500 back in December, if you're looking at the underlying index. And since then, it's been down 16%. So in Krinsky's view, we're talking about a relative breakdown here. So, it goes to show you, I mean, software stocks have certainly been, among the best performers for some time as technology has done relatively well. I mean, it's a bit of a different story this year when you look at the 11 main industry groups in the S&P 500. You see technology, toward the back of the pack here, ahead of consumer staples, but pretty much behind everybody else.
Day to day in the grind, that's David Wilson. Are these tech companies linked to the big tech names, or are they two separate worlds?
Well, I mean, there's sort of a one and the other element to it. There's no doubt the big tech companies lately have been setting the tone. But you take an example from late yesterday, McAfee, the security software maker, which just became really an independent company a few months back. They came out with their first set of quarterly results. They didn't go over well. The shares were down as much as 6.5% late yesterday. Haven't seen any trading today. It's definitely going to be one to watch, though. And that's sort of consistent with some of the concern we've seen, particularly in software stocks.
I mean, I look at this, John Farrow, and this is this raging tech battle as we look at general strategists like John Golub and other. I mean, Mr. Cooperman's coming on, who I believe is a little more cautious, to say the least. And these are the nuances amid that huge divide.
Well, let's take the Golub price target over at Credit Suisse right now. Lisa, 4,600 on the S&P 500. Can you get there without the participation of big tech? And I think a lot of people would struggle with that idea.
I think a lot of people would say that you could have participation, but perhaps they would lag behind, right? There still would be, John, this cyclical push to the entire market, even if tech perhaps isn't at the forefront.
Well, let's talk about a cyclical push right now and go to the numbers out of GM. We keep going back to this, and I know I sound like a broken record, so forgive me. This quarter, huge demand. There's huge demand in this economy right now. It's about whether you can meet that with supply. And we saw the difficulties from Caterpillar last week, warning about that for the year ahead. We saw that from Ford as well. You don't see that in GM in a big way this morning. The stock's up by 3.3% before we catch up with Mary Barra in about an hour from now. But here's an interesting line, Tom, just on the inventories. 335,000 vehicles over at GM. Almost half the 668,000 of a year ago. That coming from our Detroit bureau chief, David Welch, there on that particular stat, Tom. Now, that's important. These companies are starting to run lean of inventories and running lean quickly.
Very, very quickly, David Wilson. I mean, you've covered this for Bloomberg for decades here. This General Motors it's not Albert Sloan's General Motors of 1926 or even what you and I knew 30 years ago.
Well, I mean, with this wholesale transition to electric vehicles, that's certainly
They're really
true.
doing it, aren't they? I mean, that's the heart of the matter.
Well, they kind of have to. I mean, Tesla's really kind of laid out what happens if you move into that area. And we've seen a lot of companies go there as well. I mean, Ford, Volkswagen, plenty more.
David Wilson, thanks so much. Greatly appreciate that this morning. John Farrow, I look at the Mari Barra thing, and, again, I go back to a hugely homogenized press statement, and it's going to be interesting to get some color on it.
Lisa, I want detail. I think Tom wants detail. I think we want detail on what Ford has done and what Ford has got damaged by, got hit by. What's GM doing that help them avoid it?
I want to bring this detail, the idea that net sales and revenue actually missed expectations. That net sales and revenue, $32.47 billion versus the estimate of $32.77 billion. I'm trying to square that with earnings per share. What was the reason for their actually operating either more leanly or making more profit per vehicle, John? And this really is a question as people are able to raise prices on everything and anything related to a car due to the shortages.
First quarter earnings were a blowout. The stock's up by 3.5%. And I think we're all on the same page here. A lot of questions for the leader of General Motors in about an hour from now, Tom, when we catch up with the chairman and CEO. What is GM doing that Ford hasn't been able to do? And it keeps coming back to that E word. It's execution. And that's what we've all been grappling with over the last 6 months in this market. It was almost a simple trade. You picked a sector, you picked a factor, you picked a style, and now it's within those sectors where things get a little bit more nuanced. And we saw that last week with Pinterest and Netflix, with arguably some payback for the pull forward. We didn't see that with Alphabet and Facebook. What are we seeing this morning in the auto sector? Something we didn't see with Ford, we're seeing with GM.
Well, yeah, and we're seeing what Andrew Slyman said yesterday, which is an 11% miss on earnings guesstimate. Chris Verone publishes the chart guy moments ago at Strategas, and he makes clear, John, the bark is worse than the bite out of yesterday. You and I were going back and forth on that after the surveillance nap, and, you know, the bounce back was tangible.
The bounce back was tangible this morning. Futures up 15.
No, I meant the markets,
on the
not
S&P,
the nap.
the NASDAQ, up by 0.6%. Go on, Lisa.
It's nuanced.
Is it Nuanced Wednesday?
No, I think it's, what is it? Sleepy Wednesday?
No,
what is it?
it was going to be
Snooze Wednesday. Yeah, it was a nuanced Monday.
It won't be in a couple of minutes when Leon Cooperman joins us, the Amiga Family Office Chairman and CEO. We'll catch up with him shortly. Equity futures up 0.4%. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance with your market up 0.4%. Your bond market yields higher by a basis point at 160.67 and euro dollar 120.11. This is Bloomberg.
One of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, it means you probably mounted a very strong immune response, okay? And you recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, you know, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Okay, traders, you did it. We did it. Position closed on Japanese yen. It took us, as you can see, from 10:30 until, what time is it now? 1 o'clock to make profit. In our case, we made £500. In your case, broker send you information and your profit confirmation. Okay, let's move on. Let's not stick to one winnings. Let's look for another chance and opportunity to trade and make a profit on Forex trading. If you're looking to find out more about our strategy, you can get it from our website, company.co.uk. We also publish a short video in a couple of days about this trading, and you can find it through our channel, youtube.com//SGTrader. Okay, so if you will look for today is 5th of May 2021, you will find short video, and you wouldn't have to sit or stay if you're just learning for 2-3 hours until you will see how this trade was completed. On another hand, if you're a day trader, if you purchase the strategy, you need to know this kind of stuff. That's why we stream live our trades. It's not delayed, it's live, and you will see, you will trade with us, you copy our trades. Stay safe, and I'll speak to you later. Good trade, well done.
Wasn't for material and commodity prices as well. That's been a big issue through earnings season so far. I say it's been a big issue. The actual story, though, has been that margins have held up and held up well.
We go into 3 days of job economy out to that million statistic widely presumed. And John, I look at the supply shocks across the nation and frankly globally, and it makes it an ever greater mystery where we are Q4 of this year.
I think this Friday's a mystery, Tom. Demand's huge. We can see that. We can gauge it in all the different data points we look at in the American economy right now. But hiring 1 million people, hiring more than 1 million, 1.5 million, that's a real effort. What we need to gauge this Friday is not the demand, it's whether these companies can actually hire people at the price they're offering, at the wages they're offering right now. And I think that's going to be an interesting part of the issue, the debate that we have this coming Friday.
I mean, what's so important here, Lisa Abramowitz, is the fully employed concept of a fully employed America. The Fed has really picked this up as a social theme as well. I mean, Lisa, what was your recollection of the quality of fully employed, say, Valentine's Day pre-pandemic?
Well, that it was getting better, although fully employed, that the participation rate, if that's what you're referring to, has been coming down somewhat. To John's point, though, and to build on what Thomas Kosterg was talking about, this idea that the benefits that were paid out during the pandemic in some ways may inadvertently or advertently lead to higher wages, because in order for companies to attract the workers, they will have to pay more. This is becoming a political debate, but it's also a fascinating economic one, Tom, as we see whether there is the labor force to meet the demand to hire them.
Let's frame this for Leon Cooperman before we do the data here. Lisa Abramowitz, Mr. Cooperman, I believe, has a caution on the market out 1 year. State the case as you see it.
Well, the idea is, where else are you going to go? Are you going to go into bonds? Are you going to go into anything else? You're not going to see a massive crash necessarily in stocks. At the same time, you're getting inflation. You're getting these cost pressures that we heard about from General Motors. I will just say that he himself, in a recent interview, said that he did get a new car, among others, although he traded in a 2002 Lexus for a Hyundai. So Leon Cooperman, I'm sure, can talk all about the supply-demand
dynamics. He's got a 12-car garage, so we know where that's going.
I don't know.
As well. John Farrow, I look at the debate here that we've got here on the equity markets right now, and it's what everybody's looking at. And I think we forget, John, it's expecting out 6 months, 9 months, a year out.
What does 22 look like? Deceleration. How big is that deceleration? We're still working our way through so many huge distortions. And the analogy that I've used right now for the American economy, and others have shared that view too, is that it's like holding a beach ball beneath the surface. This was a mandated recession. Now the policy's changed. The beach ball is surging to the surface again and going even higher. We've got to work out what it looks like in 22, 23 as a return to trend growth, and what does normal actually look like? Do you know how many people come on the show, on other shows, on networks like this, and talk about the return to normal? What is normal?
Oh, it's true. And that's better said than what I said, John, about February pre-pandemic. Was that normal? And we really don't know in hindsight of this natural disaster. John, let's start with oil, $70 a barrel. Good morning.
Brent flying year to date and over the last 12 months too. Crude doing okay. Right now, WTI 66 handle. Bond yields higher by a couple of basis points, Tom. 161 on 10s.
A little rebound.
Euro dollar 120, muted price action, unchanged on the day. And futures bounce back about 0.4 on the S&P, up 0.6 on the Nasdaq 100.
Very good. Now, let's get right to it because I know you widely anticipate this. Leon Cooperman joins us with decades of experience on Wall Street and the guys in his building of a certain wing of Goldman Sachs ages ago, someone that people hang on every word, Leon Cooperman with Omega, and their family office chairman and CEO. Leon Cooperman, we want to talk about the markets front and center, but I've got to ask you once and for all, as we have seen time after time after time, the hiding of leverage on Wall Street to get to some form of point of greed, and it always ends ugly and shakes market confidence. Has Archegos and all that secret leverage that no one knew was there, has it harmed permanently our market confidence?
Nothing is permanent. Everything is cyclical. It's just evidence of greed, basically. I mean, the fact that after long-term capital, the industry would get into this kind of predicament again. I don't know whether I would say so quickly, but get into the same predicament again is kind of surprising. And I guess they wanted to make a margin on what they lent this fella. And, I would say that the more things change, the more they remain the same.
Lee, John here. Good to catch up as always. Good to see you again. What do you make of the increased demands for transparency disclosures of the hedge fund community and maybe even family offices as well off the back of that incident?
I don't get the idea of the family office. I tell everybody I'm like Hyman Roth in Godfather 2, which I've only seen 100 times. And I never get tired of it. There's a scene at the airport where right before they shoot Hyman Roth, he says, I'm a retired executive living on a pension. And I think of myself, I'm a retired money manager living on investment income. The bad news, I no longer have this giant income I used to have when I ran a hedge fund. The good news, I have no pressure. I run my own money. So why they have the right to regulate me is beyond my wildest dreams. But look, we're in a very strange environment. A lot of crazy things are going on. I think the market structure has been destroyed by a number of moves made by government. And we'll have to just work ourselves through it. In terms of the market, I describe myself as a reasonably fully invested bear. The fully invested part is all cyclical. Given all this decades of experience that Tom attributed to me, I've said that, bear markets don't come about because of immaculate conception. They come about because of certain fundamental factors. Accelerating inflation, we don't have that. Hostile Fed, we don't have that. In fact, I'd say the Fed is too accommodative. It comes about because the market smells an oncoming recession. The fact is we're coming out of recession. Corporate profits are terrific, and so the normal conditions that cause a bear market are not present. And the other one I would mention is, a significant geopolitical event, which you can't forecast, but we have plenty to worry about: China, Iran, Taiwan, etc. And I think the biggest plus out there is the Fed has created an environment where there's an absence of alternatives. You referenced this when you were chatting before, but essentially there's an absence of alternatives. And what's happening is everybody's being pushed out in the risk curve. The investor that used to buy T-bills, he concluded or she concluded, I can't survive on zero, so I'm going to take duration and inflation risk and I'll buy T-bonds.
Yep.
The T-bond buyer says, I can't get by on 1.6%, so I'm going to buy industrial credits. The industrial credit buyer says, I can't get by on 3%, I'm going to buy high yield. The high yield buyer, there's no such thing as high yield anymore, but the high yield buyer says, I can't get by on 5 or 6%, I'm going to buy structured credits, CLOs and stuff like that, which tend to have a higher yield because they're more opaque. And then the bond guy who buys CLO, or lady, basically says, well, I'll tell you what, the market's very high. I'm going to put 25% of my money in equities. And the equity person says, I'm going to put 2% in Bitcoin. And so everybody's been moving on the risk curve. That will change. I have to say, while I'm reasonably heavily invested, I'm having a very good year, that I am more focused on the longer-term issues. Since I'm running my own money, I don't compete against the S&P 500. I'm an absolute return guy. But it seems to me, if you step back and think about what's going on, it's very, very clear. We are borrowing from the future. We are borrowing from the future. If you had 100 economists on your show and you asked them, what is the potential real growth of the U.S. economy over time, the answer would be centered around 2% real. And that you get there because 1.5% productivity growth, 0.5% labor force growth, that determines real growth, that's 2%. You speak to a bear, they'll say 1.5%. You speak to a bull, they might say 2.5%. But the response is centered around 2%. This year, the economy in real terms is going to grow 3 to 4 times potential, yet we're persisting in trying to hold interest rates at zero. Makes no sense to me. I understand, and I'll explain why in a second. Secondly, prior to the $1.9 trillion package, prior to the $2 trillion package, prior to the last 10 days, $4 trillion of infrastructure spending, we've already injected into the economy $1 trillion more of transfer payments than income that was lost. So what's really going on is very simple. Prior to the virus hitting, we had about 5.5 million people unemployed. That ballooned to 23 million people. It's now down to around 9.5 million people. And monetary and fiscal policy has been conducted in a manner to get the unemployed back down to the 5.5 million pre-COVID. And they're less concerned about the long-term issues or damage they might be creating. So that's one thing. I think we're borrowing from the future. That's number one. It's very clear. You know, the debt that we're racking up will have to be paid, and unless you're into MMT, which I'm not, this is going to create a long-term issue. Second point I would make is there's a shift taking place to the left of government. The people in charge now are going to go for higher taxes. We're going to have higher inflation, higher interest rates, which I think will be a straining influence on multiples. Okay, I think inflation is going to be worse than Mr. Powell, Secretary Powell, is assuming. Every company I talk to and every business, I came back to New Jersey from Florida. I'm a Florida resident. I came back to New Jersey and I had lunch the other day at the local place called the Milburn Diner.
How was that, Lee?
I asked the owner, how's business? It's coming back, but I can't find labor. I can't find labor.
Lee, we're seeing that again and again. We see it in the earnings. You hear it in the reports. You hear it in the calls too. So you said at the start of this comment, you said you were a fully invested bear. Let's take this conversation a little bit further. Why fully invested if you've just gone through all the issues you've just gone through?
Well, because, the near-term outlook, the conditions that would lead to a big decline, like I said, is accelerating inflation. We don't have that there. Most importantly, we have a hostile Fed when you go into a bear market. We have a Fed that's extremely friendly. They tell you they're going to keep interest rates low, not only this year, but we're going to keep them low next year. Well, I'm assuming they're going to be surprised by inflation. It's going to be more intractable, and the market's going to be surprised because the Fed will raise rates sometime in 2022. They'll be forced by inflation.
So
that's my view.
You said that you're
the cyclical versus secular outlook.
Yes.
The long-term outlook. Let me explain. I got my MBA from Columbia Business School on January 31st of '67. I was broke. I had a student loan. I had a 6-month-old child who's now approaching 55. Okay, I had no money in the bank, and I couldn't afford a vacation. So I went to work the next day. I started my career at Goldman on February 1st of '67. The Dow was roughly 1,000. And in 1982, 14 years later, it was roughly 1,000. So I think we borrow from the future. I expect very little action from the S&P. Everything I look at would suggest to me caution, intermediate to longer term would be the rule of the day.
But Leon, how do you remain cautious if it's not bonds, right? If cash perhaps is losing value because of inflation, if equities perhaps have borrowed from the future, are you going more into Bitcoin?
No, I don't know. The only Bitcoin I own, let me just say this, on NFTs, Bitcoin, stuff like that, you talk to somebody else, because I tell people that I turned 78 a week ago, and basically I'm too old. I don't understand that stuff. It's crazy to me. It makes no sense. I own a little bit of gold, but compared to my net worth, I own very little.
Okay.
I'm basically a stock, a meat and potatoes guy. I'm a stock guy. So stocks make more sense than anything else because of Fed policy. But when the Fed policy changes, I think the market's going to have a response to that.
So when you say, though, that you've got your eye on the exit, what is your eye? How are you going to exit? What does that mean? Does it mean more cash?
Yeah, I would say, look, in a bear market, the winner is he who loses least wins. So, when the market goes down, I'm going to lose money. I'll be worth less. I understand that every asset has been inflated by monetary policy, every asset, whether it's real estate, etc., stocks, bonds for sure. I think the bubble is not so much the stock market. The bubble, I think, is the bond market. And I would say this, if that turns out to be wrong, I've had a negative view of bonds for quite a long time. But if that view turns out to be wrong, and interest rates belong where they are, you don't make double-digit returns in the stock market. I believe in the capital market line. What you earn in a bond has relevancy for what you should earn in the stock market. So if bonds belong at 1.5%, you probably earn 4 or 5% a year in the stock market. But what I'm looking at for the exit are traditional things. I'm looking for change in Fed speak. I'm looking for change in the posture of the Fed. I'm looking for at inflation. I'm looking at gold. I'm looking at the overall economic activity. Let me say this. If I had to give you a list of positives and negatives, I'm more impressed by the negatives.
Well, here's a negative right now. I've just got a downside surprise on the ADP report, Leon. Just let me jump in, Lee. 742, downside surprise. 850 is what we were looking for, Tom. 517 of the previous month. So it's a small downside surprise, Tom. 742,000, 850K was the estimate. Going into payrolls Friday, of course, looking for a big number this payrolls Friday. 995, Tom, is your median estimate going into Friday's print.
You know, yeah, I look at it, and it's what it is. It's ADP, and it's the correlation here to the Friday report is not all that good. Michael McKee joins us now, head of all of our economics on this. Michael, I look at where we are on ADP, and I say, well, can you link it to Friday? And you've told me time and time again, you can't.
What if I told you you could? Just kidding. You can link the sort of direction and magnitude without linking the absolute numbers, and that's why I think the market's maybe a little bit rattled, shall we say, by a number that is at about 100,000 less than we anticipated from ADP. But it's one of those strange events that people trade on that doesn't necessarily give you a lot of accurate information about where we're going to be. The only thing you can say is it's pulled the rebound has pulled ADP up. We're now 742,000, and it looks like most of the gains are spread out between small, medium, and large businesses almost equally. Manufacturing 55,000 jobs though, and service providing 636,000.
So that's at service.com.
Signs of a rebound.
John, what do you see in the markets before we get back to Mr. Cooperman?
Well, I hate this game, so I'm doing it through gritted teeth. Equity futures take a little bit of a leg higher off the back of this.
Oh my God!
Of 1%. I hate the bad news, good news story, but for the Federal Reserve at least, this goes back to a conversation we had this morning about Standard Chartered and Steve Englander teeing up a Friday number. What would it take to spook the market? How big would the number need to be? Not how big would the miss need to be?
Right.
And maybe a downside surprise is producing that Goldilocks result. Thomas, a tiny move. I don't want to draw too many conclusions off a very small move and a very small downside surprise as well. 742 still big.
Long ago at Goldman Sachs Asset Management, Leon Cooperman sat there and said, you got to be kidding me. We don't own enough Apple. Leon Cooperman, I want you to talk about what Michael Mauboussin, one of the great thinkers on Wall Street at Credit Suisse and Legg Mason, has always said, is we're going to see this massive concentration of digital success stories. Can I be overweighted Apple or Amazon, or are they so much the fabric of this nation that you got to own them?
Well, I own them. They're not cheap stocks, but they're not expensive stocks. Nothing is expensive if interest rates stay here. I went back, by the way, and I looked at the Nifty 50 of 1972. In 1972, when J.P. Morgan U.S. Trust was ruling the roost, they had the philosophy only the right stock at any price. They don't care what valuation they paid, as long as they were world-class growth companies. Avon, 65 times earnings. Polaroid, 90 times earnings. Sears Roebuck, 35.
The heart of the matter, Leon Cooperman, and you are what I would call intellectually extremely constructive in your caution. You know that the financial media is overwhelmed by the gloom crew. Every Friday they come out, the world's coming to an end, and to their point, they're trying to avoid a Polaroid or an Eastman Kodak. How do you sidestep the Polaroids that won't make it?
Well, that's a function of your discipline and your approach. I look at the stock market, I see three stock markets. I don't see one stock market. The first stock market I see is the FANG market. And, you know, the market's been extraordinarily disciplined, I might add. You know, for somebody that's cautious like I am, I have to say I'm impressed by the market action. Because the big correction has come in the so-called FANGs that have no earnings, very little in the way of revenues, and they're long on promise. Things like Amazon, Facebook, Microsoft, Google, they've held in very well. And they're not expensive against interest rates. Okay, the secondary, so they're Nifty 50 today. There'll be a high failure rate, like there was a high failure rate in 1972. But what ended the Nifty 50 in 1972 was a tenfold increase in the price of oil, led to a global recession. You know, we need a recession, or we need a change in Fed policy to change the attitude. until we have that, the market will play.
Well, Lee, that's not going to happen for a number of years, maybe. We're talking about an interest rate hike
I don't know.
in 2024.
I don't know what's going to happen. That's what the Fed tells you. But I think that Mr. Powell, I think he's doing a disservice, frankly, when he says the market's not expensive because of where interest rates are. If interest rates are belong where they are, you don't make big returns in the stock market. You basically, the world's turned upside down. Okay, so what I was saying before, the long-term issues to me are, number one, we're clearly borrowing from the future.
Yeah.
The economy growing 6 to 8% real, interest rates shouldn't be where they are, and we should not be injecting so much fiscal stimulus into the economy when the economy is growing off the charts. Okay, secondly, we have a government in charge, and I voted for Mr. Biden because I thought we needed change. I voted my values, not my pocketbook, but the truth is, if you look over the next 12 months, we have more inflation, higher interest rates, and higher taxes. Not particularly bullish. Third point I would make is we have a massive growth in debt. This nation was founded 245 years ago. We had no national debt. 3 years ago, we had $20 trillion in national debt, and that's going up at the rate of like $3 trillion a year. And that debt has to be serviced, and it's going to reduce the long-term growth potential of the economy.
So, Lee, I hear all these concerns, and you're going through them point by point, and I think it resonates with a lot of our audience, but this falls into the should-shouldn't debate a lot of the time. This is what they should do. It's what they shouldn't do. It's what they've done. And we've got to accept that now, Leon, and you've got to put money to work, as you always do. So, Lee, the question I've got for you is, what are the signposts you're looking for, ultimately, to get you to de-risk? If you're fully invested now, and here's a whole long list of things you're worried about, what are the signposts you're actually looking for to materialize that actually lead you to de-risk, to take some money off the table?
I'm listening to Fed speak, see how when they change or start to change. I look at the stock market, and the stock market's a high-quality leading indicator. There's no indication. I mean, the market's been very disciplined in its action. I'm looking at the price of gold, which has been undermined by Bitcoin. I'm looking at inflation. I'm looking at economic growth.
Leon, you mentioned earlier you're looking at Apple as one of the stocks you own. Doug Cass writes in. He's listening down in Florida. Good morning, Mr. Cass. And he wants to talk about the post-pandemic softness that we will see in Apple, in Amazon, and the others. Are you adjusting for an Apple that stumbles after the pandemic's over?
I have no credentials in Apple. I sold Apple much lower. I had a nice profit. I got out much too early. I do own, Microsoft. I do own Google. I do own some Facebook. I do own some Amazon. But I would say this, another point on the cautious side, from my days back as a strategist at Goldman, I recall that the stock market normally peaks in line with the peak rate of change in corporate profits. That's the second quarter into June. Profits this quarter will be up 50%. Yeah. Okay? And for the third quarter and fourth quarter will be up much less. They'll be up much less. So I'm watching a host of indicators as to when to get out. Yeah. And I'm prepared to lose money because, frankly, in bear markets, the winner is he who loses least. I'm not a big short seller. I believe in the long-term outlook for what I own. Yeah. I own Athene at 7.6 times earnings. I own Cigna 12.5 times earnings. I own Mr. Cooper at 5 times earnings. I own Google 28, 29 times earnings. Not so bad. I own Navient 4.5 times earnings. I'm a great believer in the capitalistic system. When companies earn excess returns, it attracts capacity and capital and kills returns. The energy industry is the best example. Yeah. I came into this year overweighted energy, and everybody hated it. It was 3% of the S&P down.
And you crushed it. And you absolutely crushed it, Leon, when it came to energy stocks. Just real quick here. You're talking about the fundamentals, and yet today we see that a downside surprise was met with buying action. Has a dovish Fed become more important to stock valuations than fundamental growth in the economy?
I think that the market structure has been destroyed, and I say that for a few reasons. When I came to Wall Street 50-odd years ago, the commissions were 25 to 50 cents a share, and the Volcker rule didn't exist. So the Bob Mnuchins of the world, the Stanley Shopcorns of the world, made markets, they carried inventory, they took risk. You can't do that anymore because there's commissions are near zero, and there's no vigorish, and there's no reward for risk taking. So the brokerage industry don't stabilize anymore. Secondly, 80% of the volume used to be done in the New York Stock Exchange. 80% of the volume today is done off-board in dark pools, so the specialist system doesn't stabilize. And thirdly, for some unexplained reason, I've written to the SEC, they ignore me, like my wife, basically.
Really?
Basically, I told them, In 1938, they enacted the uptick rule to deal with the abuses of the 29. It worked effectively for 70 years. Then in 2007, they eliminated the uptick rule, and that gave rise to a lot of these quantitative trading systems, which know nothing about value. They know everything about price. So they buy strength, they sell weakness. And when this market has a reason to go down, right now it does not have a good reason to go down. When this market has a reason to go down, it's going to go down so fast your head's going to spin. And
you're going to be on the following daily, so we can talk about it. I knew there was a reason that you and Tom Keene got on so well. You have that in common. Your wives ignore each other.
Yeah, it's amazing. It's amazing.
Lee, it's good to catch up. Thank you,
Lee. Mrs. Keene is saying,
why
don't you have Cooperman's, checkbook? I mean, that's what I'm hearing.
I know, you've got to work that out, Tom. Leon Cooperman there of Remiga. Coming up, Michael Ferroli, JP Morgan chief US economist from New York City this morning. Equity futures up about 0.8%. Alongside Tom Keene, Lisa Abramowitz, Jonathan Ferro, live on Bloomberg Radio, on Bloomberg TV. This is Bloomberg Surveillance, with bond yields higher by a couple of basis points to 161. Euro dollar down a tenth. Euro dollar at 120.02. This is Bloomberg.
Focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
This is basically going to kick off the whole week.
From bank earnings.
Bank earnings really have to be front and center.
To tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America.
There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
City for our audience worldwide. Good morning to you all. Alongside Tom Keane, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market shaping up as follows in the United States of America. On the S&P 500, we look like this, up 16 points, advancing about 0.4%, up around about 0.7% on the Nasdaq 100. Some headlines crossing the Bloomberg terminal, a couple of them. One is on the debt ceiling. The other grouping of headlines we need to get into as well is the Treasury refunding announcement. So let's bring in Mike McKee for a little bit more. Good morning, Mike.
Good morning, John. Yeah, the interesting numbers for the markets are 41 billion in 10-year notes, 58 billion in 3-year notes, and 27 billion in 30-year bonds. These are not significant changes from the previous auction levels, although we did see the Treasury on Monday say they're quadrupling the amount they expect to borrow this month, so more auctions. But the headlines you're talking about is the Treasury Department is bringing back concern about the debt ceiling. It was suspended by Congress 2 years ago and comes back on July 31st. We've talked about some of the implications, but the big deal, of course, is always, will the U.S. default? Nobody ever thinks they will. Republicans, however, some of them have been suggesting they may hold it up again. Today, the Treasury says they are evaluating scenarios on the debt cap and, of course, the extraordinary steps they take, like stop investing in government pension plans and things like that. The red headline here is that they may run out of room more quickly than they have in the past. The extraordinary steps may not keep us going as long as they have in the past. So a warning from the Treasury Department to both the markets and members of Congress on Capitol Hill that maybe they don't want to play around with this.
And what we're seeing right now in the bond markets, 10-year yields take a leg higher now at 162.27 on the heels of some of these headlines, in particular about the debt cap. How much is this something that can be remedied in the next couple of weeks, or is this going to be a persistent overhang to markets until the very end as Congress deliberates over how to extend this?
Well, the betting has been, Lisa, in the markets that this will get done because Democrats control Capitol Hill, but they have only that one vote margin. So if any member of the Democratic Senate wants to hold things up, and the Democrats have done that when Republicans administrations have been in place, they could do that. The feeling, though, is that they'll stick something into the budget deal they're trying to do for infrastructure that will keep this going. Treasury says they expect Congress to get this done, but they are warning if they don't, it could be a problem.
Michael, other than you predicting the Denver Broncos Super Bowls that have never happened, this is the single strangest, weirdest thing I've ever seen. We are out 5+ standard deviations, fiscal to GDP, trade to GDP. The Republicans are up on their Calvinist moral high stool talking about the debt ceiling as we are drowning in debt and drowning in an active deficit as well. You and I know from our youth that the debt ceiling is nothing more than a political tennis ball to be batted around. Is it the same now?
It is the same now. The one difference is
What's the difference?
In 2011, the Republicans pushed back against the Obama administration, and they let the U.S. get very close to default.
And you and I were over on the other set sweating. Remind us what happened there.
S&P downgraded the U.S. To AA from AAA, and that was a had a major impact, if short-lived, on the bond
I'm sorry,
market.
John. I just thought we needed a history lesson because it would never happen.
I get it.
In the
That's
United
totally
Kingdom.
fine. I just want to jump in on this. I'm trying to understand how you can simultaneously warn about these issues, Mike, and also reduce your cash balance to the Treasury as well, and cut your auction sizes of T-bills for that very reason. If you're worried about the debt ceiling, why would you be reducing your cash balance?
Well, the problem for the Treasury is that the law says they have to. When they suspended the debt ceiling and Congress said it would come back on July 31st, they said that the Treasury had to have their cash balance down to about $150 billion. Now, the Biden administration lawyers have looked at that, and they think it can be higher. They think they're only going to have to go down to $450 billion, but we're at $1.2 trillion now. So that's one of the reasons we've had a lot of upset in the very short paper market, because Treasury is spending down this money and has reduced bill sales. So it's going to get complicated for debt managers between now and July 31st.
Michael McKee, thank you so much. I just, this is a flashback, folks, to hear people talking about the debt ceiling with a gazillion trillion dollars of debt, running all our economics and very busy here in the next 3 days. Michael McKee, of course, as we move to Jobs Day. Now joining us for a 4-hour conversation is Michael Feroli. He's with JP Morgan. He has a brilliant essay out with Team Casman on Friday on goods and services and on this odd job economy. But Michael Feroli, I got to rip up the script over what we saw. You and I adore Benjamin Friedman of Harvard Economics. He's one of our most important thinkers. And I'm going to go back to Benjamin Friedman, The Moral Consequences of Growth, his classic book of 20 years ago. Explain right now the moral consequences of debt as we wring our hands over something as strange as the debt ceiling.
So I agree with where you were going in your previous conversation. It is kind of odd to be focusing on the debt ceiling at this time. Certainly over the last few years, we haven't worried that much about the deficit. And at this point, as you say, Congress selects revenues, they select spending. The debt ceiling should be a residual of that, and the fact that it's a concern is a bit unique to the U.S. My understanding is that this can be extended via reconciliation, so hopefully this shouldn't be too much of a headache for the markets or for the economy this year, but that's something we'll have to just wait and see.
As far as I understand, looking at this Treasury refunding announcement, the auction size is the longer end left unchanged. Yields just a little bit higher off the back of this announcement by a couple of basis points or so. Michael, just going into the payrolls report this Friday, how big are you looking for that number in America? How big are you looking? North of 1 million? And what are the risks around some of these companies just not being able to meet the demand by not being able to hire the people?
Yeah, so we're right near consensus looking for 1 million. We think the risks are fairly balanced. Obviously, this morning's ADP numbers suggest there could be some downside. But as has been the case over the past 12, 13 months, the range of uncertainty is obviously quite a bit larger than normal. There are some technical factors here in terms of how we seasonally adjust the numbers that could really skew things one way or the other. But either way, it should be a pretty big number. But if we have a miss of a couple 100,000 on either side of that, I wouldn't really change my thinking about the overall course of the recovery. So expect noise, but expect it to be a pretty big number.
Mike, do you think labour shortage translates into higher wages in the next couple of months? There's going to be this compositional issue in the number on Friday, but beyond that, do you think it does?
Yeah, and I think you're right to say the next couple of months, right? So when we think about some of the issues that are weighing on labor supply, one of them is working parents having to be at, not having to be, but liking to be at home in this kind of unusual schooling environment we've had. Another may be, and this is a little more controversial, that the unemployment insurance bonuses may have raised people's reservation wages and made them a little more picky in what jobs they accept. Both of those are temporary. So school schedules should come back to normal in September. That bonus payment ends in September. But in the next few months, I do think it may be, a little bit tight in the labor supply front. And perhaps we saw a little evidence of that last Friday. We had a fair bit stronger than expected employment cost index, which was kind of ignored. But that could be one of the, signs that we are facing some labor supply shortages, but I would think they're somewhat transitory in nature and that we should loosen things up, I think, as we get into the fall and winter.
What'll make you think, Michael, that they're not transitory, that perhaps there is some credence to that idea, that the benefits made people a bit more picky in terms of what they're willing to accept with respect to wages, in addition to rising input costs, in addition to some of the constrained supply chain issues that have caused prices to go up just generally?
Right. So I think we want to distinguish wages and prices. For wages, we're just going to have to, if those factors really do subside after September, then we can take stock of how data developments after September start to play out. And we're just going to have to wait until then. I think on prices, it's a little trickier. So certainly some of these bottlenecks are going to be putting upward pressure on certain categories. I think one area that might be useful, in the past, the Fed has kind of drawn attention to things like the Dallas Fed trim mean. And what measures like that do is strip out extreme movements, both to the upside and downside, to get a better measure of the central tendency of inflation. Things like that may be worth looking at. I think, over the next few months.
Michael, just to wrap up here, we got those ADP numbers. They came in disappointing, and you've got all these people coming out and saying, A, they don't correlate with the monthly jobs report out of the government, and B, they're really noisy and messy, and their methodology doesn't capture people who are getting rehired by the same company. What would you say in terms of the ADP's predictive ability?
Even in the best of times, it hasn't been great. You know, over the past year, you've had misses of over 1 million. Obviously, we've had pretty big swings over the past year. You know, I think, but given the range of misses, what we saw this morning isn't that far from what I think we and the consensus are expecting for private payrolls on Friday. So I would say, you know, perhaps this takes out a little bit of risk of a really huge upside or downside surprise on Friday.
Michael, got to leave it there. And Mike, I've got to say, it's nice to see a fuller office over at JP Morgan too.
I was just going to say, he's whipping him into order there.
Yes, slowly.
It's bustling.
With the help of Mr. Diamond as well. Michael Ferroti there.
He's got
of
6
JP Morgan.
interns sitting behind him.
Mike, thank you. Well, isn't that a story in some ways, Tom, that the interns, the individuals that have just joined the company, the analyst community, they want to get back to work. They want to learn. At the upper end, they want everyone back too. Middle management. It's a different one.
There's a little step, inch by inch, step by step, doing the Three Stooges strategy. And John, yesterday, for the first time in ages, I saw the acclaimed Bloomberg tour at our wonderful world headquarters.
There we go.
In New York.
The new hires getting shown around.
Yep.
The HQ in New York.
Every
we want to see
step
more
of
of
the way,
that.
Getting back.
Worldwide. Just get back to normal slowly, Lisa.
Yeah, and I got to say, there is this interesting bifurcation between upper and middle management and the lower, the incoming classes, and the whole idea of culture. And has culture changed during the pandemic due to, I don't know, more tech? Younger generation more used to it, John?
Did you see that snow days are getting banned?
Yeah.
Snow days get banned?
Yeah.
For the kids of America. Snow
How are
days
you going to ban a snow day
Because
if it snows
you
3
can just do it
feet?
remote.
There's no snow days. It's all remote now, TK. That's it. The kids
Okay.
have to do it
It's
remote.
un-American.
I agree. Coming up on the Open.
Is there
Looking
any-
forward to
is there
catching up
such a
with
thing as
Francis
un-British?
Francis Donald and Manulife.
They say un-British
and
to the
JMP
United
Security
Kingdom.
CEO.
You should shake your fist, Tom, when you say that.
Lehman. Tom, you cram me up. From New York City this morning, good morning. Equity futures up 16 points.
God, we're going to break the debt
4/10
ceiling. What do we got to do?
Yields up 2 basis points at 161.38. Give it a couple of weeks. It's all you'll be talking about. This is Bloomberg.
With the First One News, I'm Ritika Gupta. General Motors reported stronger than expected profit growth in the first quarter. GM gave the credit to booming sales of full-size and higher-margin sport utility vehicles and pickup trucks. The automaker says the global chip shortage will continue to affect output, but it maintained its annual forecast. The New York Times posted first quarter profit that beat expectations, even though digital subscription growth fell short. The Times added 301,000 subscribers to its online edition. It now has 7.8 million subscribers in print and digital. And it's a warning of the geopolitical risks that come along with the green energy transition. The International Energy Agency says the Western governments should consider stockpiling critical battery metals such as cobalt and lithium. Production and processing of some of those minerals is highly concentrated. The top 3 producers account for more than 75% of the world's supply. And London is emerging from lockdown, bruised by Brexit and a pandemic that hit the UK capital harder than other regions. London accounts for a quarter of the UK's output. It suffered almost 30% of the drop in payrolls nationwide. Residents are moving to the suburbs, and Britain's exit from the European Union is draining away high-paying workers in finance. And President Biden wants 70% of U.S. adults to receive at least 1 dose of the coronavirus vaccine by July the 4th. According to the CDC, 56% of adults have received at least 1 shot. The president says that to make it easier, the government has been encouraging vaccination sites to offer walk-in appointments. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There. We need to export there. But right now, we need a domestic focus. And so at least for the first 18 months, a lot of my focus will be domestically.
Gina Raimondo, one of the most interesting people working in Washington. Whatever your politics, the former governor of Rhode Island is absolutely fascinating. Now our Secretary of Commerce. This is going to be an important conversation. David Rubenstein joins with peer-to-peer conversations right now, and with Carlisle. What I love about Gina Raimondo, David, and just one of the great stories out there, is her ability over years to just keep moving. Her father lost his job at Bulova. I actually remember when Bulova Watch collapsed in Rhode Island, and she made good on it in venture capital and in politics.
Yes, I mean, she has an incredible story. She came from a blue-collar family. As you point out, her father lost her job. Nonetheless, she went to Harvard, was near the top of her class, Rhodes Scholar, Yale Law School, venture capitalist back in Rhode Island. She chose not to go to New York or Washington or L.A., went back to Rhode Island and really built a good business before she got into politics.
Well, she got into politics and you know, got what I would suggest high marks in a challenging Rhode Island. And it is a Rhode Island that all agree has a worn-out infrastructure. She's focused on that right now.
That's correct. Infrastructure is something that Rhode Island really needed. She helped reform that and also did a lot in the pension area, elected governor twice. And interestingly, she chose to come to Washington. She could have stayed as Rhode Island governor, maybe run for president down the road herself. And she could not, she could still do that, of course, down the road. But she wanted to come to Washington and really help President Biden do the kind of things he's trying to do. So she's a point person on the infrastructure plan right now.
A point person with respect to infrastructure, also a point person with respect to our policies with China, especially considering the record trade deficit that we just printed due to all of the imports from that nation. How does she talk about free markets, but also having a national focus? Can you square these ideas?
Well, the administration hasn't really changed a lot of the Trump trade policies yet. They haven't taken down the tariffs with China or the tariffs with Europe. I suspect that some things may get negotiated with Europe. She implied that, but she didn't say it would get done for certain. And maybe the tariffs will come down to some extent. We don't know for certain. But right now, the administration is focused domestically on the infrastructure bill, and they don't really focus right now on new trade agreements. And I don't think they really want the kind of trade agreements that President Trump negotiated or tried to negotiate.
But there's an idea here that perhaps is behind Biden's proposals, that the government can foster good spending that can generate corporate growth. How does she talk about that in terms of the commerce of the United States versus federally funded programs that are one and done?
Well, usually the Commerce Department is often taking CEOs overseas for trade missions to build plants and factories overseas. This administration is not as focused on that. They want to make certain that companies here are building more jobs here, and that's their focus. So I don't think that she's going to lead a lot of trade missions, so she didn't say she wouldn't do that. Right now, though, she wants to get the infrastructure bill through, and they recognize they'll have to compromise on some parts of it for sure.
David, do you have a working number on in your head what that compromise is? I don't mean to, the Washington parlor game, but does it come in, does it ease back a little bit to get done, or do you really see a much lesser statistic?
Well, there are two different issues on the compromise. What's the size of the infrastructure bill going to be? And there are two different infrastructure bills, the traditional infrastructure and the so-called CARE infrastructure. I think the administration would like more than half of what they propose, so it's unclear exactly what the number will be. The Republicans seem to be at a little bit less than half. And then the other issue is the taxes, corporate taxes and personal income taxes. I think the administration made it clear they're prepared to compromise on taxes for sure, but they don't want to put a number out yet until they kind of know who they're negotiating with and what the other side really wants.
I look, David, at the compromise to come here on infrastructure, and it folds into capitalism in America. Should we have a more pure bill, or is Gina Raimondo going to say we can do a more complex bill?
Well, I think she's one of several players that are going to try to make a difference here. But I think right now, this is something that's likely to go forward over the remainder of this year. I think it's not going to get done that quickly. The infrastructure part is maybe easier. The harder part is the tax part. As you know, tax legislation usually takes a year or more to get through Congress, particularly when it's dealing with tax increases. Senator Manchin has said that he could support a corporate tax rate of about 25%. The president's proposed, a much higher rate. But I suspect some corporate tax rate between where it is now and 28% will probably get done. In terms of individual tax rates, it's unclear, but I'd be surprised if there is no individual tax increase at all. I suspect there'll be some.
David, As an investor, as the co-founder and co-chair of Carlyle, how much are you relying on some of this infrastructure to get done? How much would it getting done or not getting done change your outlook and the way that you invest?
Of course, infrastructure is something that the country could benefit from, and the infrastructure the president's talking about would be good for the economy. There's no doubt it would create jobs, and there's no doubt it would help in many different areas. For example, telecommunications. Our infrastructure on cell phone towers is really not exactly first world. It can be much better, as we all know, when trying to use cell phones and the calls drop. There are many different things I think would help the economy, but it's hard as an investor to say, well, if this bill passes, the impact will be felt in 2 or 3 years. I'll make an investment right now, take advantage of it. It's too unclear right now.
Although there's a question about the optimism, the balance of risks, that if there isn't some sort of optimism about future growth, it's hard to invest in assets at these valuations. Leon Cooperman just said he was a fully invested bear, and talking about how he can line up all of the arguments for why markets should go down, but they just aren't right now. What's your view on that? Are you a fully invested bear, or are you looking out to some of these programs and saying it could change the trajectory of this recovery?
Well, of course, the economy's been pretty good the last couple of months, and because of the stimulus, it's likely to continue to do pretty well for some time. The Secretary of Treasury sort of walked back her comments on interest rate increases, so I suspect the markets will do well today as well, because there was some concern yesterday about interest rate increases possibly coming along. But I'd say for the next year or so, maybe 2 years, I think the economy is likely to do quite well. Down the road, 2 or 3 or 4 years from now, it's hard to predict. At some point, things will slow down, but the stimulus is still working its way through the economy.
David, thank you so much. Really look forward to Secretary Raimondo. With David Rubenstein, of course, peer-to-peer conversations. It is the General Motors Company. It has been around since 1908 through various and sundry iterations and has been reinvigorated with Mary Barr. She's Chairman and Chief Executive Officer of General Motors. Here's our David Weston.
Thank you very much. So, Mary Barr, it's a good day for you, a good day for Will Durant, who started General Motors all those many years ago. So, looking at the numbers, one of the first things I look at is the top line, the revenue, and then the profitability. The profitability, you did so much better than anybody expected, you actually almost put a shame to analysts. At the same time, it wasn't because of increased revenue. So, my real question is, how did you do that? How did you get so much more money in profit out of relatively flat revenue?
Well, I think it's a number of issues. First, strong demand for our full-size trucks and SUVs. I mean, the Chevrolet Silverado, the GMC Sierra, the Escalade, the Tahoe, et cetera. There is exceptionally strong demand for those products. And so I think that's what's driving a very high average transaction prices. Because the demand is so high, we've been able to continue to be very disciplined on incentives. And then our financing unit, GM Financial, has done an excellent job of taking advantage of higher used car prices and just a very strong market. We're also seeing recovery and return to strong sales in China. So across the board, they contributed to the strong numbers.
So you surprised perhaps some people by saying not only will we stick with our guidance going forward for the rest of the year, but if anything, we think it's going to be toward the upper end of that guidance. At the same time, you have the problem with chips. We talked about it last quarter, something like $1.5 to $2 billion being left on the table, as it were. I think that number still holds good. And yet you're doing much better than some people across the street at Ford, for that matter, Fiat, Chrysler, Peugeot. Why?
Well, again, there's not a lot of transparency between the different automakers of what's happening. We're focused on GM, and I think what's been incredible is the work that we're doing with our purchasing group, our engineering group, our manufacturing group, and sales and marketing, and working with suppliers. You know, we've been working to build strong relationship with our suppliers for many, many years now, and there's just a team that is looking, understanding what chips are we going to have access to, how do we allocate those to our highest demand and products that we have limited or no ability to recover because there's just such strong demand. We run those manufacturing operations around the clock, and they're just being creative and doing what engineers do of problem solving and in some cases re-engineering to get the chips to the right products and to just find every opportunity we can to build a car, truck, or crossover and get it to the customer.
So it's a mixed question, not just of the vehicles you sell, but also where you direct your chips, it sounds like. You want to direct it to the ones that really are the most important. Are you getting more chips, do you think, than you would have expected because of your purchasing department?
Well, again, there's not a lot of transparency to say more than, we were very clear last year of what we thought the demand was going to be this year and the chips that we had ordered. And so, we're continuing to work with the supply base on that. And again, but I think it's looking for every opportunity and managing it centrally, and also working hand in hand with our JV in China. So across the board, we are just really being, I think the team is being really scrappy and finding ways that we can build the vehicles, not only full-size trucks and SUVs, but also our electric vehicle programs. And I think it's important to note that even with the challenges of the semiconductor shortage, there is no impact on our electric vehicles, on our autonomous vehicles, and the growth initiatives that we've been talking about this first quarter.
That was one of the questions I had, both for the Hummer that's coming out later this year, and then the Lyriq, which is coming out or sometime the first half of next year. Is there going to be any delay because of the chip problem?
Absolutely not. And I can tell you those vehicle programs are on track, and I'm really excited to have customers get in those vehicles and drive them, because I think they're going to be amazed.
We understand the $1.5 to $2 billion number that was put up before, but can you give us some sense, those of us who don't understand the supply chain, if you had 100% of the chips you needed, what percentage are you getting now? Are you running at 50%, 75%?
It's a very dynamic situation. And so, again, I think it's every chip we have access to, we're making sure it gets into the vehicles where we have really strong customer demand. But it's something that changes every day, David, so I'm not going to put a number on it.
This problem isn't going away in the sense that as you go forward, you're going to make more and more cars. They're going to require more and more chips. What is the longer-term solution to this so we don't have this sort of problem you have this year?
Well, I think we are going to see recovery. We think Q2 will be the weakest for the year. We'll see some recovery in Q3, Q4. And we're working on a lot of long-term strategies. I don't have anything to share right now, but there's a whole menu of things that we're working on, processes that we're changing. So more to come later in the year of how we'll make sure we're never in this situation again. But believe me, we have a dedicated team working on that as well.
When it comes to batteries, you've sort of vertically integrated, as it were, with a joint venture where you're making your own batteries. Is there something like that, perhaps, that would make sense for GM?
I'm not going to take anything off the table. We're going to look at what we can do to make sure that we have the right number of automotive-grade chips, and that it doesn't constrain our growth, because we see huge opportunity not only with the product portfolio we have today, but with the strong electric vehicle products that we have coming.
We hear some in Washington, both the Commerce Secretary and also I talked to one of your Michigan representatives yesterday, Haley Stevens, who suggested perhaps there needs to be some co-investment from the government as well as the private sector in chip production. Does that make sense from your point of view?
I think making sure we have a secure supply chain for the growth that I think we're going to see, I think it's something that we all have to work together on, and we're having regular conversations with the administration and members of Congress to find the right solution, and we'll continue to do that.
In your presentation today, General Motors really lays out a fairly robust program to really go to electric vehicles and to really deal with greenhouse gases over the longer term. You have very specific targets you're setting out there. How do you hope to achieve those?
Well, I think it's making sure there's a whole ecosystem that when a customer looks at, can I buy an electric vehicle, they say, I'm going to have a better experience when I buy an electric vehicle. It's going to be a beautiful vehicle. It's going to be in the segment that I want to purchase, because we can't, a person, if they want an SUV or a crossover, they're not going to buy a sedan. It's got to meet them in the market where they want. But then it's also making sure there's a robust charging infrastructure, and we're working on that as well. And that will be not only what we're doing, for instance, we're putting charging in our workplaces, but also working with communities, and then working with all the startups that are in this business, connecting those. We just made an announcement that we're going to provide access to 60,000 chargers across the country to really give confidence to customers as they buy an EV, and even if it's their only vehicle, that they're going to have a robust charging infrastructure. And I think all those things combined, beautiful vehicles, meets their needs, the right range, and then charging available, customers are going to move to EVs.
And importantly, I think for many investors, people who watch your company, I saw in your presentation, you expect to have the same profit margins on EVs as you have on the so-called ICE, internal combustion engine vehicles.
So as we move into the Ultium platform and continue to take cost out of the battery, that is our goal to get there and have that break even and then move beyond. But you also have to understand there's a different cost of ownership in an electric vehicle versus an internal combustion engine vehicle. From a gas savings that you don't have to fuel up. So we've got to look at the whole equation, but we're on that journey, and I'm very pleased with the work that's going on with our battery technology to continue to take cost out and increase energy density.
I'm sure you're looking at supply chains that go beyond just microchips at this point. As you move into EVs, where are there possible weak spots going forward, and what are you doing to address those in terms of what you need, the supplies you need in order to manufacture the vast number of electric vehicles you're anticipating?
Well, as we look at some of the key materials that need to go into vehicles, especially those that are quite expensive, we're looking at how do we reduce the need, in each vehicle, but then also working with trusted partners in the supply chain to make sure that we have a secure supply, and that's going to allow us to grow. And so that's the work that a lot of it's done and a lot of it's underway right now.
So, Mary, as you look forward to 2021, as I say, you've said you're maintaining your guidance. If anything, you'll be at the upper end. What are the vulnerabilities? What's the sensitivity on it that might actually have you fall short?
Well, with the insights that we have right now, we believe that guidance is correct with where we think we're going to be from a semiconductor perspective. But I think, one of the things that gives us a lot of confidence is just the interest in our vehicles, the demand for our vehicles across the board. Whether it's a Chevy Trailblazer or a Silverado or an Escalade, across our portfolio, actually very strong midsize crossovers as well. So the strength of our product line, the services that we're providing, we continue to see growth with OnStar. So there's a lot of moving pieces that give me a lot of confidence in our ability to hit that, what we've said from a guidance perspective, and we're going to work it every day.
And finally, Mary, do you have visibility into the demand for your electric vehicles? I think the Lyriq, the new electric SUV, you can order as of September. Do you have any sense whether people want the electric vehicles as opposed to your current vehicles?
Well, we've seen, we can see growing, growing demand for the Bolt EV. Can't wait to get the EUV, the Bolt EUV into the hands of customers. We've sold out the Hummer EV truck and had extremely strong demand over quite some time for the Hummer EV SUV. So when we start selling the Lyriq, which is one of the highest customer feedback vehicles we've had, of just the beauty of that vehicle, when they actually get in to see it, I expect we're going to have a strong reaction in September as well. So I'm very committed to the strength of our EVs.
Okay, thank you so much to Mary Barr. She is the chairman and CEO of General Motors. This is Bloomberg.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York City, for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now, with equity futures up 16 on the S&P. We advance 0.4%, and we begin with the big issue. Secretary Yellen shaking things up with just a couple of words.
It may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat, even though the additional spending is relatively small relative to the size of the economy. So it could cause some very modest increases in interest rates to get that reallocation.
Shaking some investors until the former Fed chair returned with some clarifying remarks.
Let me be clear, it's not something I'm predicting or recommending. If anybody appreciates the independence of the Fed, I think that person is me. And I know that the Fed can be counted on to do whatever is necessary to achieve their dual mandate objectives.
Let's bring in the Bloomberg team, Michael McKee and Taylor Riggs. Morning, Mike.
Good morning, John. Well, we've all had those days where maybe we come out with a mismatched pair of socks or something. Janet Yellen apparently forgot who she was. Not that she doesn't know she's the Treasury Secretary, but she forgot she's Janet Yellen. her comments didn't say anything that people didn't already know. The expectations in the markets are that interest rates are going to have to rise. And also, we've seen, if you take a look at the curves for this year, we've seen interest rates rising already as the economy reopens. The curve has gone up significantly since we came into the year at the beginning of the year. And that just shows you that Janet Yellen's reflecting reality rather than making a prediction. Unfortunately, because she's the former Fed chair, it was seen as a prediction by many on Wall Street, and we did have that market reaction. However, after the clarification, everything seems to have settled down a bit. She says she's not predicting the Fed will do that. And so at this point, there is sort of much ado about nothing, because when you look at the Fed funds futures, the forecast for the Fed in January of next year, you can see that we're right back where we were 2 days ago before she even spoke. So you can see the little spikes in the middle there.
Yep.
Nothing before that.
A couple of points to make here. One from Paul Krugman, the Nobel laureate, who said out on Twitter earlier this morning, if it should happen to rain, we have umbrellas, says the Treasury Secretary. Panic pundits say she's predicting a hurricane. And to Mike's point, and I think it's the most important point, there was so much discussion yesterday about rates, yet nothing was happening in rates. Can we just build on that a little bit more? Taylor Riggs, your take on that? It was all about the NASDAQ. I didn't see it in the rates market at all.
Well, we're learning that the NASDAQ maybe is a long duration asset, John, right? And of course, so sensitive to any sort of change in rates. But let's be clear, and sort of Mike McKee hinted on this, that we were already lower yesterday before we got those comments. Futures at least were negative. Of course, we got the comments and maybe it made things a little bit more nervous. And we were able to climb up a little bit as we got near those 4 p.m. closing comments and the clarification. But indeed, the NASDAQ was where it's at. Mike McKee alluded to this, flip up the board. This is the bond market really taking it in stride. Of course, bond market's so sensitive because Janet Yellen's history as, of course, being in the Fed chair, but the market's still pricing in a rate hike not until 2023. So that is a very key point that Mike pointed out. I do want to flip up the board, John, sorry, patent alert, and take a look at where we are for PCE, because we've been hearing, of course, from the market, from market participants, from CEOs in earnings calls, John, that of course inflation is rising. The Fed doesn't see it.
Taylor Riggs, thank you. Let's get some breaking news. It's on Facebook. With that breaking news, here's Abby.
Well, John, we do, of course, have the breaking news that Facebook's oversight board has upheld the suspension of former President Donald Trump's Facebook and Instagram accounts. The oversight board just releasing this decision on their website moments ago, saying that they have decided to uphold that January 7th decision to restrict then President Trump's access to both Facebook and Instagram. The stock has had an interesting reaction because in the pre-market, bouncing back with a lot of the other big tech stocks, at one point up nearly 0.7% on this decision, going sharply lower, down about 0.3%, right now about flat. The reason that's interesting, John, it's unlikely to affect Facebook's bottom line, but it does, of course, have a lot of implications for Trump, the company, and of course, the political discourse here in the U.S.
There will be a political conversation about this, Abby. We need to have a business conversation about it. What I thought was interesting in the numbers in the earnings reports that we got from both Facebook and Twitter, respectively, is that we didn't see this damage Facebook's numbers quite like it did Twitter's. I think Twitter, Abby, is down about 7 days on the run. 7 days in a row, and it's really struggled. Do you think this is having a bigger impact on that particular platform than, say, Facebook, which is now positive in a pre-market?
It's a very interesting point, John, because I would agree with you that Twitter's bearish streak recently and that horrible reaction to the earnings report that was disappointing did reflect perhaps people removing themselves from that platform and that company being a little bit more punished by the decision. Facebook, however, has been very insulated by it. Their platform users not seeming to care as much. As you were mentioning, they put up a blowout quarter, and the stock right now, if I just take a quick look at it, it's back to being positive. So again, perhaps the messaging out of Facebook stronger for their decision to, again, uphold that suspension of former President Donald Trump on both Facebook platform and Instagram.
Abby, thank you. Up about 0.2% on Facebook stock in the pre-market. Just to reiterate that news and re-emphasize it, the company's independent content oversight board ruling that the former president remains banned from posting on Facebook, permanently exiling the former president from the largest social network and leaving him without one of his favorite ways to reach supporters. and goad opponents as well. That's the story on the social media platforms. Facebook now positive in the pre-market by about 0.4%. I want to turn back to the broader market and bring in Manulife's Francis Donald and JP Morgan's Phil Guarco as well. Francis, great to catch up. Let's just put this one to bed once and for all. It was the story that's dominated the last 24 hours in markets. Secretary Yellen's comments. Did you make much of it, Francis?
No, we're watching the 3 to 6 month trend. I need to see lending pick up. I need to see labor supply come back online. I need to see those bottlenecks unwind. Those are the next big macro drivers. Not a comment from the Treasury Secretary. We know rates are going to go up. Now it's about when does that taper come through? What does it look like? And what are the triggers for it? So I think we're in macro no man's land here. We're waiting to get through these distortions in the data. Market very sensitive, a little bit of asymmetric risk on those headlines. For me, a 24-hour story. Now we move on.
Phil Guarco with us now too. Phil, your take on this?
Yeah, John, I tend to agree. But personally, I think that we'd be looking for a scare on inflation. We, as a fixed income investor, if markets start to overestimate the inflation that we get, there's a trade there, right? And so we would love to start buying some duration at some point, because long term, we do think, to use the word of the past month, that it is transitory. It may not be for the same transitory reasons that the Fed thinks, but we do think long term, both inflation and rates are going to trend down again.
Well, let's talk about the risk around the bond market going into Friday. Francis, we're looking for a huge number. At Bloomberg, the estimate right now in the survey that we conduct is in and around 1 million. There is a huge conversation on what it would take to actually drive Treasury yields higher, even drive rates expectations higher. Steve Englander of Standard Chartered out this morning with a note suggesting it might take a print of north of 1.5 million, maybe more than 2 million. Francis, what's your take on that? How would you respond to that now?
We'd have to get a material upside surprise, something like 1.5 times. But what's more important is going to be what's underlying the headline. We need to see services jobs, the ones that were lost, come back very aggressively. And I absolutely have to see labor force participation rate start to come back online. There is a wages problem if labor force participation rate does not come higher. I think it does. I think that as COVID dissipates, people are less afraid, opportunities come back. But underlying the surface of this, we still have 500,000 initial jobless claims coming in per week. People are newly filing for unemployment, 500,000 a week.
Yep.
This labor market is not as strong as a lot of these non-farm payroll numbers will show us. And I think it's going to be all these underlying details, just like a lot of indicators as we lap last year's COVID recession, that's going to matter a lot more to this market.
And some people in this country believe that those entitlements being offered right now is holding back labor supply. This came from the Montana governor. The vast expansion of federal unemployment benefits is now doing more harm than good. We'll have that conversation in just a moment. I need to return back to some breaking news in the last 5 minutes, the last 10 minutes or so. Abby, taking a look at Facebook. Hey, Abby.
Hi there, John. Well, Facebook, of course, that breaking news coming out this hour that their independent oversight board has decided to uphold the suspension of former President Donald Trump's Facebook account, that platform, and Instagram. They, of course, made that decision back on January 7th after the Capitol riots, and they have decided to uphold that. The stock having a bit of a wild ride here on the morning. In the pre-market with the return for big tech, the bounce back for big tech, Facebook had been up about 0.7%. Then when this announcement came out initially, dropping sharply lower on an intraday basis, reversing down by, let's call it 0.5%, but now back higher, up 0.5%. And it seems that the messaging around this is very positive. Investors receiving it well, perhaps the fact that it is an independent oversight board. And in fact, you were mentioning Twitter and the fact that Twitter has really been in the doghouse. They had a bad quarter, perhaps some of it reflecting that suspension. Twitter has actually started to bounce back now, too, in sympathy with Facebook. So the implications for President Trump, former President Trump, very clear. The implications for Facebook and the other social media platforms emerging now with the positive results of these companies bouncing higher. That, of course, is the story for big tech overall, getting that bounce back. Apple and other big tech names are climbing, despite the fact that there are some signs of inflation. This inflation conversation really pretty incredible, but we have these big tech names higher, even though there are commodities higher, rates higher, investors not caring. The bulls are out. And of course, a piece of it right now is Facebook bouncing on that news that their independent oversight board has upheld the suspension of former President Donald Trump's Facebook and Instagram accounts, John.
Abby, thank you. Coming up on the program, President Biden once again upping the ante in the fight against the pandemic. That conversation up next.
with Manulife's Francis Donald and JP Morgan's Phil Guarco. From New York City this morning, good morning. 17 minutes away from the opening bell. Equity futures are doing okay, up 20. We advance 0.5%. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Our goal by July 4th is to have 70% of adult Americans with at least one shot and 160 million Americans fully vaccinated. That means giving close to 100 million shots, some first shots, others second shots, over the next 60 days.
President Biden is setting a new vaccination target, aiming for 160 million adults to be fully inoculated by Independence Day. As of today, nearly 56% of U.S. adults have received at least one dose, 41% fully vaccinated, according to the CDC. For more on this story, let's cross over to Taylor Riggs for more. Hey, Taylor.
John, and relative to the rest of the world, the U.S. is doing pretty okay, at least with Canada and Europe, where only about 30% of their populations have one dose. But of course, your UK firmly in the lead. The U.S., of course, really trying to set those big targets by July 4th. I do want to flip up the board because we talk about the vaccination rates and the reopening and then what that has done to cases, which of course has been what our equity markets have been really eyeing on as a key piece of fundamental news. We're getting back to where we were at the lows of last summer. And of course, that really trying to boost that 160 million people by this summer to make sure that that curve keeps flattening. Finally, let's just take a look at where we are in terms of vaccination use. I found this pretty fascinating that the U.S., at least here on the right, using a lot of that domestic use, despite at least within China, perhaps in the EU, really doing a lot of imports, and then, of course, some exports as well. We're not quite exporting. That is, of course, going to be the pressure once we really ramp up here in the U.S., but a lot of this, John, that domestic use.
Taylor Riggs, thank you. Let's continue this conversation with Francis Donald and Phil Guarco. Francis, we're feeling a little bit short here, falling a little bit short in America. The trajectory is just starting to flatten out, as many people expected it would. Do you have any concerns about our ability to get to that 70% line in the sand?
Well, what I have concerns about is vaccines, fiscal, reopening, all very bullish, a lot of good news, and the high expectations priced into the U.S. market. So maybe we don't see the same level of success in the U.S., but that's not where my focus is. My focus is, have we been too negative about Europe and Canada and other areas of the world where vaccines are actually ramping up very aggressively and may actually supersede the U.S. by the summertime? In that case, the trade to me is to focus on where we can can actually, surprise to the upside. And to me, that looks more like the Europe and Canada story. And that's true for vaccines, but it's true for a host of other macro variables as well.
Francis, you have to put on your markets hat and your economics hat as well. For the market, you've heard the same talk. You've written about it. The excuse to sell, peak reflation, peak reopening, peak fiscal, peak monetary policy. Do you still think you stay fully invested?
For now, absolutely. We're waiting for the next catalyst. I don't think that comes in the next week or two, but we do need to be mindful. We have to be mindful of China. China has a cyclical rollover. We're in the middle of it. We have to be mindful of geopolitical risks. And we have to be mindful that as our economic data gets much better, I don't think Powell does it, but taper talk is going to come back in. So there's a lot of stuff here that I don't think is currently priced. Is it coming this week? No, but in my view, you have to have an exit plan. You have to know what you're going to do and a framework for how you'll de-risk. We're just not at that moment yet.
Caught up with Lee Cooperman earlier this morning of Amiga, famed hedge fund manager, now running a family office and looking after his own wealth. Phil, I asked him what it would take for him to de-risk, because he went through a long, long list of things that he did not like, but he characterized himself as a fully invested bear. Phil, what are the signposts that you're looking for? And this was basically the question I asked him. The signposts that he would be looking for to de-risk that ultimately would benefit your treasury market. What are they?
Well, I think maybe I'm going to misdirect a bit on that question. I think you stay fully invested, but it depends where. And so as France had said, there are opportunities, especially, say, in materials producing countries, natural resources countries. And so you ride that reflation trade and you ride the potential inflation trade. So I'm thinking in terms of emerging markets, Russia, Brazil, in terms of developed markets, put Canada there. Why? Because they're all natural resources countries. And so you use them in a way to kind of protect your long duration assets. What I'm really looking forward is then when we top out, when do you sell those reflation trades, and especially the materials and natural producers, and then buy duration? And I think we do that, or think about starting to do that, when the 10-year rates go above 2%, maybe 2.25%.
Francis, how many times have we heard stay long the material story, stay long the commodity story? I want to tie two things together. Can you be long natural resources given what is happening in China and what you just described?
For now, yes, because I do think that we're underappreciating the growth outside the United States, and we are going to see demand come back online. But to your point, I'm not sure how much longer. I think we've probably seen the bulk of that move is behind us. And then, of course, there's implications, which is if energy prices continue to rise, that is just mechanically going to flow through until inflation. So I'm exactly with Phil on this. I think 2% is the level we need to get a bit more worried. Or put differently, when we start to see real yields climb back into positive territory, those, to me, that's going to be a catalyst for a variety of sectors, including natural resources. And you're right, the thing that keeps me up at night, every single night, is that China credit now contracting on a variety of metrics. That's really where I'm worried. Typically, you have about 10 months to a year, so we have a couple months left on that one, but absolutely top of the list.
Phil, just a final word on that. The credit impulse in China has rolled over. And Francis is right. If this was a year ago, 2 years ago, we'd have a different conversation about manufacturing, a different conversation about commodities too. What's different this time?
Well, I think what's different this time is we still have big regions in the world that are not engaged fully in the recovery. So yes, there may be some issues with China right now, but if you think of Europe, they're way behind, but yet European markets are doing okay. Why? They have a bigger concentrations in materials producers and industrials. So maybe, you don't do China, but I think there's another thing going on in emerging markets. I think the big talk in emerging markets over the past couple of years is new emerging markets, tech, Asia emerging markets compared to old emerging markets. My EM emerging markets as a Latin Americanist. I think what we're seeing right now is that the old emerging markets of the natural resources producers are having their day, and I think you can still stay with that trade.
Hey, Phil, good to catch up. Phil Guarco there of JP Morgan, Francis Donald of Manulife. Coming up, the analyst action you need to know. That'll be next on Morning Calls, and later, earnings shedding light on the lockdown winners starting to lose their luster. That conversation still ahead with Mark Lehman of JMP Securities, and Granite shares will rise. From New York City, this is Bloomberg.
5 minutes away from the opening bell in New York. The focus on DC, as always, up 19 on the S&P. We advance 0.5%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, B of A upgrading ConocoPhillips to a buy, $67 price target. The analysts seeing the potential for accelerating returns with the macro backdrop improving. Barclays upgrading Under Armour to overweight after reporting better than estimated results. The analysts seeing a return to high-quality sales growth and improving margins. And finally, Truist raising its lift price target to 76. The analyst expecting the company to emerge from the pandemic with strengthening momentum and richer product offerings. They're three of the calls. I want to touch base with Abby just to recap some of the breaking news in the last 30 minutes. Abby.
Well, John, we do have the shares of both Facebook and Twitter popping higher on the news that broke earlier that Facebook's independent oversight board is upholding the suspension of former President Donald Trump's Facebook account and Instagram. Shares are popping higher on this news, John. More soon.
Advancing 0.6%. More still to come. The opening bout just around the corner. Futures higher, bouncing back from yesterday's losses. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
23 seconds away from the opening bell in New York City. Futures right now up 20 on the S&P. We advance going into the opening bell. The Nasdaq bouncing back just a little bit. It was an ugly session yesterday. Nasdaq 100 futures up by around about 0.7%. There's your opening bell. Switch up the board and get to the bond market. All the talk of rates yesterday. No big move in rates yesterday. Get your head around that. 160.32 on 10s, up about a basis point on the day. Euro dollar negative, down 0.1%, in and around 120 over the last couple of days, the last week for that matter. Crude 66.26 and up 0.8%, and Brent almost there having a little look at 70 through much of this morning. That's the cross-asset price action this Wednesday at the market desk with your movers. Here's Abby.
John, let's start out with what is emerging as this morning's big stock story, and that, of course, is Facebook. Shares are popping higher after the company's independent oversight board about half an hour ago did release their decision to uphold the company's January 7th ban of former President Trump on both the Facebook platform and the Instagram platform. Clearly big implications for Trump, the company, and other social media companies as well, and the political discourse. Perhaps one reason for the bounce, and we also see Twitter having its first up day in 8, and Snap and Pinterest, less likely comps, but still just a sense for the social media, is the fact that it was an independent board. Plus, they are saying that they must re-examine the Trump penalty after 6 months, that an indefinite ban would be inappropriate. So you could perhaps make the case that that sense of fairness around this suspension and the fact that it is being judged actively is a reason for the bounce, because as you said, Twitter had that poor quarter and those down days. As for other big tech stocks that are on the move, we do have Apple and Amazon climbing, despite the fact that there are signs of inflation, which did seem to hold back that complex for a while. Everything moving in tandem in green today, a big bounce back.
Abby, thank you. A bounce on Twitter too after 7 days of losses as well. I want to bring in JMP's Mark Lehman on the Facebook story. Mark, let's just catch up quickly on what we've learned in the last 30 minutes or so. Your reaction, please.
Well, I'm not surprised. I think Facebook has tried to be a leader with this message. And I'm also not surprised that they didn't close the door on the future. It is interesting, the stock reaction, but I think that's a larger message about the move to digital and what kind of a quarter Facebook had that they just reported. So interesting news. I'm not at all surprised. But again, the stock reaction is a good one.
Mark, when you take the example of Twitter, the stock reaction of the last week has not been a good one. Let's be clear about that. For these platforms, what's the biggest risk here? The loss of revenue from not having an important person like that on the platform that drives eyes to where they want them to go, one, or two, the regulatory risk that conversations like the one you and I are having at the moment could fuel?
Well, I think it's probably both. I mean, you look at the Donald Trump being banned news, and everybody worried about how many eyeballs they'll lose. I'm much more optimistic that that's not the case. I've been saying forever, Facebook's kind of like that Daryl Hall and John Oates album that nobody bought but everybody listened to. Everybody's on Facebook and Twitter all day long. They just are. And the move to digital is not going to be stopped. And I think the regulatory specter has been one we've talked about for so long. And guess what? Nothing has happened. So I am not that worried about it. The move to digital is nascent. And that's why those platforms are going to continue to garner more share. And I think we'll have days like yesterday coming up, but the move to digital, like the move to cloud, like the move to SaaS is one that's going to happen. It's going to continue, and it's early innings.
Those platforms are positive in early trading 3 minutes in. Mark, stay close, won't you? I want to turn to the earnings story of the last couple of weeks, whether it's the lockdown companies, the reopening trades. This is what Jonathan Golub of Credit Suisse had to say.
Every kind of stock has its moment in the sun. This is the time for old economy stocks because these are companies with big fixed overhead that tend to respond more to the kind of stimulus that we're seeing proposed by the Biden administration and generally the kind of overheating we're seeing in the general economy.
For more, let's bring back in Taylor Riggs. Hey, Taylor.
Interesting. We didn't quite see that, at least when it comes to the earnings surprises. I'm going to start here at the bottom of the screen. I mean, some of the casinos, right, and the hotels, Caesars, Hilton, Hyatt, not having a great quarter, but the outlook was good. So perhaps if you're looking forward, then we're seeing a little bit of an improvement. I'm going to end here at the top. I guess we're all dating. Our mental health pets that we adopted aren't going to do it for us. So we're all going to get online on Match, John, and then Lyft, of course, after the bell yesterday, really highlighting that reopening trade that they're really seeing. It is that classic pure play, according to analysts. Let's change the board, though, and as you can see how much of this market, every guest has said that on this program, has been pricing in that forward growth that we have already been seeing because the markets are indeed forward looking. So that hotels index has been the big outperformer, in part because of all that stimulus that Jonathan Golub was talking about. And if you change the board again and do a terminal here that I'm showing inside the Bloomberg, you can see that as COVID cases have fallen, the stay-at-home trade, indeed, and the earnings outlook has fallen. That is that pivot to that reopening, that going out trade, not staying at home that you continue to see.
Taylor, thank you. Let's continue this conversation with Mark. Mark, I want to pick up on tech and just what's been happening in the last 24 hours or so. It's been intriguing for me to actually see real yields go lower
over the last couple of weeks and tech start to struggle. Mark, what's your reaction to that in the last couple of days?
I'm optimistic that rates are not going to skyrocket here. So I think that's going to continue to be the backdrop. What I'm questioning, and I think investors continue to question, is this hyper growth, both to earnings, revenues, and multiples over the last 5, if not 10 years. How long can we sustain that? I do think this move to digital, this move to the cloud, that's going to continue. But the kind of numbers and the kind of multiple expansion that we've seen is in question. And I think that's what investors are looking at. And I think that's what they're questioning. And days like yesterday will happen. I think there's still some businesses that are so early and so going to conquest the incumbents that have been there for so long that stock picking will be at a premium. Because in the last few years, if you were in this market, everybody kind of cloud lifted all boats.
Yeah.
And I think you're going to have a better time picking stocks this next 3 to 4 years.
And Mark, I want you to build on that and whether we saw evidence of that in earnings season. The likes of Pinterest struggled, others didn't. We saw that with Twitter. We didn't see it with Facebook. Did we start to see that in this earnings season, the execution within sectors? We're starting to see the stock picking come to light a little bit more.
I think so, Jonathan. I think you have much more of a stock picker's market. And when you have the question about multiples contracting, stock picking becomes much more essential. Look at Snap, which was a stock that was very questioned a few years ago, whether you could get those teens and young 20s to pay for advertising. Guess what? They're moving to that advertising platform faster than ever. You look at Facebook, which again, everybody was criticizing that nobody's on it anymore. It's a platform for guys like me, not for people that are younger. Guess what? It still is. So I think it's crucial that you find those stocks that are gaining more market share and gaining more revenue and are enhancing their advertising dollars. But I think this is an early inning story, and you pick the right ones, you're going to make money hand over fist. You got to be careful though, because some places lose volume very, very quickly. But the ones you mentioned clearly are gaining ground.
Couple of questions left, Mark. What do you think we're underestimating here? The cyclical story embedded in some of these names, Facebook, Alphabet being examples of that, or the secular story that's going to last for a whole lot longer from here?
My guess is it's much more company specific. I think this move to digital and advertising, who are learning so quickly what their clients and what their customers want. That is so early on and so early in the innings that you're going to want to play the stocks like that. I'm much more concerned that you have the wrong company that loses its viewership quickly, because you see these people, again, like Snap, who've gained eyeballs and time on the computer or time on your phone so rapidly and so much of their time. I would have thought TikTok would have taken so much of the eyeballs from platforms I just discussed. They are, but they're clearly staying on their phones and online much longer and much more importantly for the advertisers than we thought.
Mark, just a final question from me on what you're seeing in tech at the moment. You said something important, that we could get a challenge to the incumbents. Some people have concluded after the events of the last 12 months that the winners are the winners and nothing's going to stop them winning. You think some can? Where do you see the greatest threat coming from?
Listen, I think adoption online is so much more rapid than we ever would have thought, that brands live and breathe and live and die so rapidly that you got to always look over your shoulder. You look at Clubhouse, which quickly gained eyeballs and ears for the last year. You look at what people are doing with gaming that has quickly evaporated some of the market share that you see for traditional gaming. I think it's a story of our time, that innovation is accelerating, that people are putting more money to work sooner and making bigger bets. That will not die with multiple contraction. Hope is alive. The reopened trade is here, and I think people are ready to put more money to work sooner.
Hey, Mark, we'll continue the conversation through the year. Soon, Mark Lehman, JMP Securities. The president's ban on Facebook has been upheld. Facebook is up in the market right now, about 9 minutes into the session. Let's get to the market desk and get those movers. Here's Abby.
Facebook is indeed up, John. It's been a bit of a wild morning for shares in the pre-market, up about 0.6%. And then as that news came out that the company's independent oversight board has upheld the suspension of former President Donald Trump, shares actually dropped down about 0.3%. So almost a 1% intraday reversal, then higher off of the highs now. So investors are really trying to figure out what this means. But I think that the fact that the company has a process as an independent board, one that's going to review this decision in 6 months, almost feels democratic. So that might be something that investors like. On the other hand, Twitter, as you were mentioning earlier, had been in this wild down streak and is actually now lower, as are the other social media companies that on the open had been higher. So the messaging that Facebook has offered through this independent board is being well received by investors, and it has not hurt their bottom line in the way that may have hurt Twitter's, their decision to suspend President Donald Trump. In any case, their first quarter results and the outlook was not great. As for some other movers, earnings movers on the day, we have a bit of a mixed bag here. If we take a look at Lyft, we see shares are slightly higher. They offered a narrower loss as riders are returning. T-Mobile put up a very strong quarter, big subscriber growth. Activision, Blizzard, they blew it out of the water with a big 2021 view. And then GM, a blowout quarter on the profit standpoint. They held their 2021 view despite the chip shortage.
This another example of execution within a sector. Two different stories. Ford struggling, had to cut production, planned production for the second quarter by 50%, a real worry about the chip shortage. You didn't get the same tone out of GM this morning. GM positive in the early part of trading. As for Twitter, Twitter is down for an 8th straight session, the longest losing streak since January 2018. Up next, something that's not down, commodities jumping to their highest level since 2011, with the global recovery stoking demand. That conversation up next with Will Rind of Granite Shares. This is Bloomberg.
Why did you decide to become Secretary of Commerce? Because in Rhode Island, you're the 800-pound gorilla because you're the governor.
Because I wanted to be on the team that helps America build back.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news: Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
We are looking
looking at a global, multi-regional, multi-sectoral rally here, where for the first time in a very, very long time, you really have strong demand coming out of the U.S., Europe, Japan, Korea. It doesn't just have to be China that is supporting this rally.
Trafigura expecting strengthening demand for raw materials to continue with the world's largest economies reopening. This with commodities jumping to decade highs with demand for everything from metals to food and energy surging. Morgan Stanley's Andrew Shees taking a less bullish view.
We are not in a super cycle. We do think we're going to start to see some supply response to these higher prices. And then we also might start to see a little bit of demand destruction, getting your levels of copper to aluminum, where you start to see some substitution there, where it's possible in certain items. And I think where we see demand, even though we see demand for commodities coming back quite strongly, we also think that the current prices reflect that demand.
Let's talk about that demand right now. Some breaking news crossing the wire, some US data. Here's Mike McKee.
Well, John, it's not going to affect commodities markets much because it's not manufacturing, but service industries are picking up in the U.S. No surprise there. The market services PMI number for April, the final for April, comes in at 64.7. The preliminary was 63.1. So as the month went on, the services industries in the U.S. got better. Composite PMI, you put together the manufacturing, which was about unchanged a couple of days ago, 63.5, up from 62.2. Now, we get a reading that's a little more important to the markets at 10 o'clock with the ISM Services Index, but this suggests we'll probably see some good news there, some strength in the economy as the service industries come back.
Mike, you go through these numbers, the PMIs over the last couple of days, and this theme just emerges on hiring, difficulty hiring, absenteeism, all of that leading to short-term shutdowns on the cost side, rising commodity prices, shortages of basic resources. You're starting to see that tension in the commodity market, Mike, start to bubble to the surface.
Yeah, you see a lot of tension. We saw Leon Cooperman on Bloomberg Surveillance this morning saying these rising prices are going to force the Fed to raise rates sooner than expected. And he's looking at charts of what has happened in the past. If you look at the Bloomberg Commodities Index versus the PCE, which is the Fed's favorite measure, you see they track each other very closely. And the thing about that is the PCE headline number, which is what the Fed's 2% is about, includes oil and it includes food, which have gone up a lot. It also includes the industrial metals that a lot of companies use. The reason the Fed doesn't think this is going to happen, and Charlie Evans from the Chicago Fed just out on the wires a few moments ago saying that he didn't think that there's an inflation problem despite all this. When you look at what's happening with futures for most of the commodities, they're in backwardation. I don't know if we can pull up the chart on my desk here, but copper prices, they hit 10,000. They were at a record.
Yep.
And yet by next year, they're coming down according to the futures market. So the Fed is looking at the experts in the markets and saying, you don't think there's going to be commodity price inflation? Why should we?
Mike McKee, thank you, sir. Looking forward to the ISM at the top of the hour as well. Guy Johnston, Alex Steele will bring you that number. On the commodity market, Will Ryan of Granite Shares expecting the outperformance in commodities to last. He says the following: investors are starting to seriously worry about inflation and are pouring money into commodities as a hedge. A mix of bounce-back plays and longer-term supercycle trends point to a significant bull trend in commodities. Will, I'm pleased to say, joins us now for more. Will, just build on that if you can. Take that a little bit further.
Yeah, I think, what we're seeing is the result of not just many, many years worth of underinvestment on the capex side, on the commodities, but that has been met with this huge surge in demand as we rebound from the pandemic. So it's kind of a double whammy, if you will, whereby, those of us that follow the commodity markets know that there's been underinvestment for many, many years, but that is now coupled with this surge in demand coming out of this pandemic, which is causing prices to move exponentially here.
Will, can we have a super cycle with China's credit impulse going the other way?
Yes, I think we're in one already, Jonathan. I think that this is something that is not just about the so-called transitory move in commodity prices. I think that longer term, what I think is going on here is this is a fundamental shift in the way that energy is delivered to our planet. And this is a move from hydrocarbon energy infrastructure, which we've had, for the last 100 years, to a green or sustainable energy future. And that is not going to benefit all commodities. So it's not necessarily a super cycle for every commodity, but it is certainly, in my view, a super cycle for a lot of the metals and any kind of raw material that we're going to need to build this new green energy infrastructure.
Well, you talked about the lack of capex over the last decade. Good reason for that, because many of these miners got totally burned coming out of the last super cycle. They've been really disciplined. Talked to many of those miners over the last decade. They talked about a move from volume to value. With that discipline in mind, Will, do you want to play this through the commodity market or through the miners, the commodity players?
Well, I think if you're talking about getting exposure to the commodity prices themselves, obviously the only way to do that, in my view, is to buy the underlying commodities to get that direct translation. But look, I think this is an environment where, as you rightly say, a lot of these mining companies, a lot of these producers have been through very, very hard times. They've had to restructure. Balance sheets are a lot healthier than they were, several years ago. And so in the equity side, I'm sure these companies, a lot of them are poised to do well as well.
Well, I know we had some technical problems, which meant you had to join us a little bit later than expected. So let's do this. Talk to the team, come back soon. We'll have a longer conversation, and we'll ride there of Granite shares. I want to turn back to this market. Equities picking up about 20 minutes into the session with the sector price action. Here's our stock editor, Dave Wilson. Hey, Dave.
Hey, John. I mean, you're seeing energy stocks at the forefront of the gains today among the 11 main industry groups in the S&P 500. Beyond that, though, it's clearly the areas affected by big tech that are leading the gains. We're talking technology specifically, as well as the consumer discretionary category, where you find Amazon.com and Tesla, and communication services, home to Google's owner Alphabet, as well as Facebook. In terms of what's down, the more defensive areas of the market, real estate, utilities, consumer staples, healthcare, all lower. Beyond that, I want to focus in on autos, especially in light of the results out of General Motors. I mean, shares now up 38% on the year. After the first quarter results came out, we saw earnings more than double the average estimate. They maintained their full-year forecast in the face of a global chip shortage. So they pulled out ahead of Ford Motor, which is up about 30%, even though the shares fell last week when the company said it was going to take a $2.5 billion hit to earnings this year from the shortfall in semiconductors. When you put that all together, though, you see the index, it's barely changed on the year, and that's because there are 3 automakers in the S&P 500 as of December, and the third one is Tesla. And this year, it really hasn't done all that much. Shares down about 3% at the time that you're seeing these gains in GM and Ford. So when you put it all together, I mean, you end up with an index that really doesn't move, because Tesla by itself is more than 80% of the S&P 500 autos index.
Dave, let me jump in just quickly. What did GM do last quarter that Ford could not do? What's in the outlook for GM that Ford hasn't been able to bring to the surface?
Well, it really looks like, as much as anything, they're going to be able to focus on, the more profitable models, the pickup trucks, the SUVs. I mean, they know what they're up against in terms of supplies of chips, so they're honing in on their most profitable products, which stands to reason in terms of why you have that contrast between GM and Ford when it comes to the response to the shortage.
It's the E word again. It's execution. Once again, Dave, it's good to catch up. As always, our stocks editor, Dave Wilson there. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Jobs Day on Bloomberg Television. Will unemployment move lower, and how will markets react? Plus, special guest, Minneapolis Fed President Neil Kashkari. The April Jobs Report, Friday morning on Bloomberg Television and Radio.
Five minutes into the session, your equity market bouncing back a little bit on the Nasdaq, up 0.5% after getting hammered yesterday. The S&P up about 1/3 of 1%. That's the price action. Here's your trading diary, what you need to be watching through the week ahead. ISM services coming at the top of the hour. Guy Johnson, Alex Steele will bring you that number alongside Michael McKee. President Biden discussing his American Rescue Plan at 2 p.m. Eastern Time. A Bank of England rate decision on Thursday, tomorrow, plus Fed Presidents Mester and Evans speaking. And finally, the main event coming on Friday, the U.S. payrolls report with some monster expectations out there. We're approaching 1 million on the median estimate in our Bloomberg survey. More still to come on that tomorrow with some breaking news, some data through the morning. From New York City, this was the countdown to the open. Catch me on Twitter for more at Ferro TV. This is Bloomberg.
'Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts